be actually handed out to Hong Kong residents. So in this time, we'll be watching closely to see what happens. The Hang Seng Index closing out the day at 26,129 in a very down day across Asia. Back to you guys.
Emily, thank you so much for bringing us that interview. Well, coming up on this show, coronavirus fears are crippling demand for commodities. Producers are now intending to take significant steps to stem the price slump. Do stay with us.
Sluggish or weighed down can be a sign your digestive system isn't working at its best. Taking Metamucil every day can help. Its psyllium fiber forms a gel that traps and removes the waste that weighs you down. It also helps lower cholesterol and slows sugar absorption, promoting healthy blood sugar levels. So start feeling lighter and more energetic by taking Metamucil every day.
Take the Metamucil 2-week challenge. Lighten up. Just take Metamucil every day for 2 weeks. Available at your local retailer.
Exploring the heart of historic Europe with Viking, you'll get closer to iconic landmarks, to local life and legendary treasures, as you sail on board our patented, award-winning Viking longships. You'll enjoy many extras, including Wi-Fi, cultural enrichment from ship to shore, and engaging excursions. Viking, voted #1 river cruise line by Condé Nast readers. Learn more at vikingcruises.com.
Do you worry about going to the dentist? Well, relax. The Carefree Dental Card is now available in your area. Call the number on your screen and we'll send your actual card at no cost today. With the Carefree Dental Card, you go to the dentist whenever you need and you instantly pay a lot less. The Carefree Dental Card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-478-0809 to receive your free Carefree Dental Card information kit.
We are the dreamers.
We changed the world.
Because we don't give up.
IU can help you live your dream.
IU is an online college, so your campus is wherever you want it to be.
Take classes when you want to take classes.
You receive the tools you need at no extra cost.
Even a brand new laptop and tablet to use in school.
Call IU, then tell them your dream.
1-800-967-1179. 1-800-967-1179.
Next on Squawk Box, sectors on the front line of coronavirus fears. Which are most vulnerable, and where can investors turn for safety? Squawk Box today, 6 a.m. Eastern. Watch or listen live on the CNBC app.
I really look at my closet differently now. I don't feel guilty when I'm shopping. I know down the line I'm going to be able to sell it on the app and make money. Poshmark has really turned my closet into
We're continuing to monitor the latest government reactions to the coronavirus outbreak, and we have some now in the last few minutes.
Life Room by Four Seasons, where outdoor living meets
any
future
event
technology.
larger than 1,000 people in attendance, saying that smaller events across the country need to seek approval from the authorities in individual cantons, individual regions of Switzerland, before they can proceed. All large-scale events effective immediately will be banned until at least March 15th because of the spread of the coronavirus. Elsewhere, Saudi Arabia will push fellow OPEC Plus members to deepen output cuts, according to the Financial Times. The world's major oil producers, they're set to convene next week as they scramble to stem the slump in oil prices. The FT's reported that Saudi officials will ask producers from Kuwait, the UAE and Russia to collectively commit to cuts of an additional 1 million barrels a day. The coronavirus outbreak has hampered global oil demand. As I'm sure you're all aware, prices on track for their biggest weekly drop when you're looking at oil in more than 4 years. And if we look at the iron ore price elsewhere in the commodity sector, you can see it's actually bounced back a little bit over the last few days and weeks. And to talk about that in a bit more detail, I'm happy to say that we're joined by Tyler Broder. He's an analyst from RBC. Ginny Yan, the chief China economist from ICBC Standard Bank, is still with us. Tyler, let me ask you about what's going on here. We've heard so much about lower consumer spending in China as a consequence of this outbreak. What's the demand side for materials like iron ore looking like there, though?
Yeah, so there's been a real shift in the outlook for the year, obviously, following the impacts from the virus, and the shutdown that we've seen has caused the demand side to fall precipitously. I mean, you look at some of the stats, we're at 95% lower levels of construction and things like that. As China starts to move back to work now, that should start to get better. But you can't shut down a blast furnace, so the Chinese have still been producing the steel that they need normally for construction and infrastructure projects, etc. So what's happening is we're seeing a bit of a buildup of steel inventories. Those have just reached a record level, the highest level we've seen over the last 10 years, and we would expect them to continue to build. So this pushes steel profitability down and is likely going to drag down the demand for iron ore over the next few months, which is why we're concerned on the prices.
So what, in that specific context, what can authorities in Beijing do to intervene?
Well, I think it's going to be sort of some of the policies we've seen over the last 2 weeks, which is, realizing that moving back towards more normalized activity may be, perhaps have less downside overall than having lockdowns for extended periods of time, at least versus for the economy's sake. The underlying changes that you see from a stimulus perspective, that will take some time to come through. I guess our other concern as well is that China consumed 1 billion tons of steel last year. When we look at our long-term economic analysis, China's consuming a bit more from a fixed asset investment perspective than maybe they should be at this point of their economic growth, and therefore, with the potential hits to confidence and the backfilling of those 1 billion tons, there's still going to be a lot of work to do in the second half.
Jenny, clearly, if you're working on a construction site in China right now and you're not being able to travel to work, that construction, as Tyler just pointed out, will halt. As the quarantine measures, the travel restrictions in China begin to perhaps loosen, as the numbers start to look a little bit more positive, less people are dying and less people getting infected, do you have any insight into what the inability of workers to get to their place of work and the corresponding lost productivity looks like when you're looking at the economic fundamentals?
Sure. I mean, clearly for the production side, industrial production, manufacturing, a lot of the labor force is dependent on migrant workers. And this is a key. Migrant workers were told not to return to their places of work in cities and plants, etc., and prolong their Lunar New Year holidays. And the shutdown, of course, of transportation, trains, buses, etc., also has impacted on that. And that's why, even though figures are showing for example, SOE, state-owned enterprises, getting back to maybe 80% back to work, others like SME, smaller private sectors are probably nearer to 20% capacity in terms of getting back to full production. So I think probably migrant workers not being able to get back to work, and some are probably even put off by the current situation. The prolonged period of the sort of impact on the economy and the spillover of the virus impact on the economy, the more likely that migrant workers will start to look elsewhere for work. They might, for example, go into the services sector, looking for digital type of technology type of work. And this is why my biggest concern is on unemployment. If, for example, tomorrow's PMI data shows that the unemployment sub-index showing signs that not only are people being delayed from getting back to work, but also layoffs are happening, this is what will panic policymakers in China and probably will boost a further thought about how else can we ensure that unemployment doesn't happen at a big scale.
Tyler, I want to switch tack slightly. The US dollar, the last couple of days, because of the way the money markets are now pricing in a Fed cut, we've seen it slightly come off the boil. And of course, it's been incredibly strong in recent history. What's that meant for the commodities complex, and what could it mean if that dollar continues to weaken?
Yeah, I mean, that would be the big saving grace here if the dollar was to continue to weaken. From what we can gather, it's very much been a move in sort of positioning around the euro in a large part, because we have seen a lot of the emerging market currencies where a lot of these metals are produced have been falling, and so there's a bit of an offset there. But a weaker dollar would completely help.
It's really improved my life because I really look at my closet differently now.
The metals prices, but it would also help in terms of the emerging emerging market economies and putting less pressure on them from a financial perspective, which is where, with metals and mining, a large majority of the world's consumption comes from.
Tyler, we'll leave it there. Thank you so much for coming this morning. Tyler Broder from RBC and Ginny Yan, Chief China Economist from ICB Standard Bank. Well, coming up on the show, in the midst of a deep global sell-off, we've seen what could be the world's largest buyout deal this year. We'll have more details on that for you after this break.
The kitchen is where family and friends spend most of their time. That's why it's easy for cabinets to become worn or faded with use. Give your cabinets a refresh or a whole new look with enhanced wood refinishing. Our innovative process offers a much higher quality and durability than just painting your cabinets, and more convenience and a lower cost than traditional kitchen remodels. Get the beauty and long-lasting finish you dream of with the convenience and affordability you desire. Enhance. Wood refinishing done right.
For drug-free sinus and allergy relief, experience Navage.
This time of year I get so stuffed up, but Navage flushes my sinuses so I can breathe again.
Navage uses powered suction to flush out allergens, germs, mucus, and dirt.
My doctor recommends Navage to breathe better through my nose, and it works. Congestion's gone, and I feel great.
And Navage is so much easier than a neti pot.
Trusted by happy noses everywhere, Navage is nature's decongestant. Online and at these fine retailers.
All the parts that you need to keep her on the road. For work, for school, everywhere you go. But sometimes they can be hard to find. Rock Auto's got the parts for whatever you drive. Up you on that work truck, you just save some big bucks. All the parts you're looking for delivered to your front door. All the parts your car will ever need. Rock Auto. All the parts your car will ever need. RockAuto.com.
Think you need to buy expensive skincare products to see dramatic results? Try Olay Skincare. Just 1 jar of microsculpting cream has the hydrating power of 5 jars of a prestige cream, which helps plump skin cells and visibly smooth wrinkles, while new Olay Retinol 24 provides visibly smoother, brighter skin. For dramatic skincare results, try Olay and now receive 25% off your purchase at Olay.com. Brand power helping you buy better.
The world's newest ocean cruise line is yet again a world's best. Viking's elegant ships deliver a superb, inclusive experience. With enriching shore excursions, alternative dining, all veranda staterooms, Wi-Fi, and much more. We're very proud to have been named a world's best 4 years in a row by Travel and Leisure readers. Learn more at vikingcruises.com.
Wondering which credit card is right for you? Introducing CNBC Select, the authority on all things credit cards. We do the research, you reap the rewards. Head on over to cnbc.com/select and take control of your money.
Welcome back to Street Signs. I'm Willem Marks. I'm in London, and these are your headlines. Continental correction. The Stock 600 continues the global sell-off after the Dow plunges another 1,000 points and markets head for their worst week since the financial crisis. Travel and leisure stocks lead the declines. Shares in airline group IAG plunge after it issued a profit warning about the impact of coronavirus. And the dollar continues to slide as investors pile into the yen, while money markets put pressure on the Fed and price in at least 3 rate cuts for 2020. And finally, a German town is placed under quarantine in a move that could isolate as many as 1,000 people, while Switzerland bans large events as the virus spreads further into Europe. Well, you can see the sell-off continuing here in Europe apace. The FTSE 100 now down more than 4.5%. That's more than even half an hour ago. The Xetra DAX well past 5% down this morning. And in Paris, the CAC 40 4.5% lower. FTSE MIB approaching a 4% drop so far at the moment. Let's look at the currency markets because there's a lot of movement there as well. As you can imagine, the euro stronger against the dollar. And you can see this dollar weakness right across here, weaker against the yen, weaker against the pound, weaker against the Swiss franc. You imagine a lot of investors looking at the Swiss franc and the yen for some safety. The pound, interestingly, trading slightly stronger against the dollar, given all of the rhetoric from number 10 Downing Street here in London about walking away from trade talks with the European Union. If we look at the US futures, of course, ahead of the open on the other side of the Atlantic, really, really significant to see quite how much it looks like the Dow Jones is going to be opening lower at the moment after those extraordinary few days of drops there already. And one of our major stories here in Europe this morning is that ThyssenKrupp will sell its elevator unit to a private equity consortium led by Advent and Cinven for 17.2 billion euros. The deal, the largest European buyout since 2007, essentially highlighting the growing buying power of private equity groups. I'm happy to say my colleague Annette Weisbach joins me now live from Frankfurt with more details of this deal. Annette, we knew this was coming. What we didn't know was how big this deal would be.
Well, it was actually rumored that the deal will be the biggest private equity deal in Europe for a decade, so since 2007, like the pre-financial crisis here. So I guess still the price is still on the upside, so that's why we have seen ThyssenKrupp shares yesterday rallying by almost 5%. So essentially it's positive news for ThyssenKrupp in the short term at least, because they can trim down their huge debt pile they're sitting on. They have 16 billion euro of debt, and that needs to be trimmed down because they have not enough equity and cash flow to service that in the end. So equity is literally evaporated. We see ThyssenKrupp as a huge restructuring case. They were trying all sorts of strategies in recent years. None of them worked. Last year they tried to merge their steel business with Tata Steel. This didn't get through regulatory approval, and this was a big hit to the overall strategy. Then we had the management overhaul, and now the new CEO, she's trying to concentrate ThyssenKrupp back to its roots, back to the steel business, essentially stripping all assets which can be sold from the company apart from the steel business. And the elevator business is the crown jewel of the business, and that's why it could attract so much interest from private equity, but also industry groups. There is some criticism that in the end private equity got the deal done and not, for example, the Finnish elevator maker Kone, which from an industry logic would have made perfectly sense. But rumors are suggesting, or sources are suggesting, that this deal didn't come through because there might be regulatory hurdles to overcome, and ThyssenKrupp needs the cash now. They don't want to wait. So what's next for ThyssenKrupp is most likely we'll see more asset sales coming from them. Their loss-making, parts of the loss-making car supplier business, but also their industry business is under question. We see an end of an era, like some commentators here on the ground are suggesting for ThyssenKrupp, but short term is actually really net positive for the company that they're getting that deal done with a higher than expected price tag. Back to you.
Annette, thanks for some of those details on the deal there involving ThyssenKrupp. Appreciate that. Annette Weisbach live in Frankfurt. Well, let's switch back to Asia, where, of course, a lot of the indices have seen a very, very difficult day as well as the global market continues to sell off. I'm happy to say I'm joined now by the Nikkei's Mikiko Itsuda with a bit more detail on what happened there in Japan in particular.
Yes, the Nikkei index finished down 3.7% as the global market sell-off continued amid heightened coronavirus fears. And Tokyo stocks plummeted Friday following an overnight plunge in the U.S. market, and it fell for the fifth consecutive day, hitting a 6-month low, slicing nearly 10% off the index in a week. Investors piled into the yen against the dollar, driving the Japanese currency up 1% to a high of 108.9 yen against the dollar. Now, meanwhile, Japanese Prime Minister Abe took drastic action to contain the outbreak by announcing the closure of all public schools starting next Monday. And this has triggered panic and criticism among working parents as they scramble to secure for childcare or find ways to work from home. And critics say Abe's unprecedented move was motivated as government support waned, as well as to keep the 2020 Tokyo Olympics this summer on track. Now, Tokyo Disney Parks operator Oriental Land announced that both Tokyo Disneyland and Disney Sea will close through March 15th in line with the government's request to avoid holding big events for 2 weeks. And it will be the first time the parks will close for an extended period since 2011, when a massive earthquake and tsunami hit northeastern Japan. Many other public events have been cancelled, and concerns are mounting as it seems inevitable that there will be a significant economic impact felt in the days ahead. That's all from the Nikkei. Back to you.
Makiko, thanks so much. Makiko Asuda there from the Nikkei. Well, US markets have undergone corrections 26 times before this week. Those corrections have averaged 13.7% in declines over a period of 4 months. They've then required another 4 months roughly in order to recover. Manish Singh, as the Chief Investment Officer from Crossbridge Capital, he's quite positive about the potential, presumably, for the markets to recover in that kind of time frame?
Yeah, if you take end of year review, from where we are, then I don't see a trade between buying a 10-year US Treasury at 1.2% or 1.27%, or buying a blue chip stock where you get your yields which are at 2.7 or 2.8%, right? Because even if the yield on the 10-year was to go to 1%, it might go. I'm not saying it will not go. You make, 2% return? You get that on a dividend stock. And low cheap debt also means buybacks, because it's not just one-way trade. It's going to be done by the corporates as well. And then you will get the earnings increase, any earnings increase that is going to come through. You will end up doing better. So it totally depends on what do you buy your equity and bond for. If you buy equity and start expecting bond-like return, then of course you're not going to get it, and you will have to deal with the volatility. So you have to see this through. Also, there are various things to look at, and I think Matt Ridley mentioned this. It took years to sequence the genomes for HIV. It took weeks for SARS, and it took days for coronavirus. So there is something which is being done, and one has to be hopeful that there will be a cure coming through. And you will need a coordination. And I think you're seeing signs of coordination on a government level, which is coming up now.
So let me ask you this. How unusual is the current combination of factors in the market? Gold rising slightly, not as much as you might think.
Yeah.
You've seen these 3 days in a row of record low yields on the 10-year US Treasury. You've got these massive, massive plunges on the major indices when you look at equities. How does this compare to, say, pronouncements on US-China trade developments, the Brexit vote? Is this significantly more unusual in terms of the combination of factors than happened then?
I would say that there are a few things, not just this, but what it means for US election. I think I'm more concerned about that. If coronavirus was to get worse in US, then I think Sanders' chances increases, because you can imagine Sanders' campaign playing a split-screen video where problems on healthcare in the US, let's say the insurance bill rises for poor families, and then on the other side he'll play China government building all the hospitals containing the virus, and his whole plan is free healthcare for everyone. So you can guess where people are going to go.
Well, it's interesting you say that. There was a columnist from the Wall Street Journal making this similar point the other day, talking about the idea that if this virus spreads, if people without insurance can't afford to be tested or treated, that becomes the major issue he was positing of this election.
Yeah. I mean, that does become major issue, which is why I'm saying that you are going to see far more reactions because alarm bells will start ringing that, how it could go worse. I don't think that, we are heading there. I'm just saying that could be a scenario that one has to be careful about. So I would be more about the election outcome than what I am seeing now, because you've seen containment in China, which is working well from what we are reading, and you're seeing European governments taking actions as well, and you will see more of these things happening.
Let's talk about the US government taking action, and in particular the Fed. Of course, money markets pricing in an absolutely skyrocketing probability of a rate cut in March. Will the Fed have enough information available to it at that point to make a decision like that, do you think? Will they worry about the impact of cuts later in the year ahead of that November vote?
I don't think they have enough information, but this is about sentiments. Because you remember in 2008 when you had a crisis, short selling was banned in the US. I mean, for a capitalist economy to ban short selling, and you do everything to shore up the confidence in the market. And that's very important, because otherwise it leads to second round and third round effect, which becomes worse. So if they have to do rate cut, they were planning to do something in June, and they have to do this in March, they will go ahead and do it. And the sequence is very clear. You had this in 2010, 2011, all the corrections you've had Fed action. Q2, Operation Twist, QE3, stopping hiking rates and then cutting rates. So I think you will get the Fed to act again.
Manish, we'll come back to you in a bit. Thanks for being with us this morning. Manish Singh is the Chief Investment Officer from Crossbridge Capital. Some corporate stories, of course. The owner of British Airways IAG says it cannot yet offer any guidance for the year, but it does expect to take an earnings hit because of the coronavirus outbreak. IAG saying the cancelled routes to China will impact capacity growth and will likely lead to cuts in its short-haul flights in Europe. It joins its rivals, Lufthansa and Air France-KLM, in implementing a spate of cost-cutting measures for 2019. The UK airline owner posted a fall in operating profit of almost 6%. That was due in part, if you remember, to a pilot strike. Elsewhere, Rolls-Royce posted a full-year operating loss of £852 million as record deliveries failed to offset costs that related to the company's Trent 1000 engine. The aerospace engineer also flagged the impact of coronavirus and called it a macro risk that will hit air traffic growth in the near term. BASF already feeling the impact from coronavirus as the outbreak has started to weigh on demand. The German chemical company said the virus heightened uncertainty in the global economy in January and February. And, of course, Munich Re net profit, well, that sank 9% in the fourth quarter on the back of major losses from some of the natural catastrophes we saw around the world. But a €216 million profit still beat the analyst estimates, and its gross premium income, a key metric, of course, in that insurance business, that jumped 5% to €12.5 billion. The German reinsurer said it is on track to meet its profit target for 2020. Facebook has announced it will cancel its F8 conference due to fears over the coronavirus. The conference, which attracted 5,000 people last year, was scheduled to be held on May the 5th and 6th in California. Microsoft, meanwhile, currently still scheduled to hold its own developer conference in May, but it has withdrawn from a gaming conference scheduled for next month. Airbnb, meanwhile, could provide a major test of the markets amid all this current turbulence. The online home sharing market is a potential IPO candidate this year and is looking to expand its offerings. My colleague Deirdre Boza has more details.
Coronavirus could impact this year's most anticipated IPO. Airbnb is particularly vulnerable as the outbreak raises fears about a downturn in demand for travel. Its global footprint has grown to more than 7 million listings in over 200 countries. 2 million people on average stay in Airbnbs each night. Now, the company has already suspended bookings and offered refunds in several Chinese cities, including Beijing, and it's monitoring official guidance in other impacted areas. In a statement, the $31 billion startup says they're focusing on how to best support stakeholders, including hosts, guests, employees, and communities where they operate. Shares of its potential comps, that's comparable public companies, Expedia and Booking Holdings, have slid 20% and 40% respectively over the last week as they face cancellations and weigh the future impact. Now, all of this does not bode well for an IPO. Airbnb may have to adjust its own outlook, and typically companies want to project more certainty and put their best quarter forward when tapping public markets. That's looking increasingly difficult. Kathleen Smith at Renaissance Capital notes that valuations in the travel sector have contracted, and that will impact the valuation calculus for Airbnb. Tom White at D.A. Davidson says there's a real risk that coronavirus could delay its debut. Lastly, guys, it's not just Airbnb. Market volatility is dampening investor appetite for new investments. Large and other IPO plans are already being put on ice. DoorDash, though, did file for its IPO this morning, but it did so confidentially, essentially meaning that it can wait in the wings for as long as it wants, or perhaps that it needs to raise capital. Deirdre Boza, CNBC Business News, San Francisco.
Well, coming on the show here, Christine Lagarde plays down fears about the coronavirus outbreak, but says the infection is being monitored carefully. We'll have more details for you about that after this break.
Day one, 50 Peloton rides to start the year. Here we go.
Don't stop here, Peloton. Remember why you started.
Halfway there, just hit a 5-day streak.
What's that mean?
It means Daddy didn't quit.
I don't get it.
Almost 50 rides. Boom!
We did not wake up to be mediocre today, Peloton.
Okay, just another meeting.
Come on. You didn't wake up to be mediocre.
Hi, Phil Swift here. People everywhere tell me how much they love the Flex Seal family of products.
This stuff is awesome.
It really works. Nothing compares to the original strength of Flex Seal. Flex Seal Liquid, Flex Shot, Flex Tape, Flex Glue, and Flex Paste. Use the Flex Seal family of products to weatherproof and protect virtually everything. Even make quick repairs underwater to help prevent flood damage. Seal up large cracks and holes to keep those nasty pests out of your home. All Flex Seal products create a super strong watertight barrier. Patch busted pipes, seal gushing gutters. Now you can coat, patch, seal, and repair. And don't forget about our portable Flex Seal Minis, perfect for quick repairs on the go. Imagine everything you could do with the Flex Seal family of products. Available at these fine retailers.
We are the dreamers.
We changed the world.
Because we don't give up.
IU can help you live your dream.
IU is an online college, so your campus is wherever you want it to be.
Take classes when you want to take classes.
You receive the tools you need at no extra cost.
Even a brand new laptop and tablet to use in school. Call IU, then tell them your dream.
1-800-967-1179. 1-800-967-1179.
If you're living with diabetes, then you understand the difficulties, from painful finger sticks to worrying about highs and lows. If you haven't heard of continuous glucose monitors, listen closely. A continuous glucose monitor is a breakthrough technology that reduces finger sticks and warns you of dangerous spikes in sugar levels. If you meet these requirements, you may qualify to receive a CGM from Solara. Solara, your single-source solution for better diabetes care.
Seeking safety from the sell-off. Finance expert Jeremy Siegel. Where investors are turning now as global markets hit correction territory. Squawk on the Street, 10 a.m. Eastern today. Watch or listen live on the CNBC app.
Welcome back to Street Signs. We're continuing to cover and monitor government responses to the coronavirus outbreak, and we've got a statement now from the Chief Medical Officer here in England, Professor Chris Whitty, saying there's 2 new cases of COVID-19 that were passed on in Iran. They are now being treated at the Royal Free Hospital just a few miles away from us here in London. We've also had a confirmed case in Wales, the first in Wales, along with 1 case in Northern Ireland. That brings the total across the UK to 19, with 17 of those cases here in England. Let's take a look at the US futures before the market opens on that side of the Atlantic. The Dow Jones currently looking to open 600 points down. That's after several days of pretty extraordinary losses. The Nasdaq also being called more than 200 points lower, and the S&P 500 certainly looking to open soft at this stage of proceedings. Meanwhile, ECB President Christine Lagarde has downplayed coronavirus fears and says the central bank will not be reacting imminently. In an interview with the Financial Times, Lagarde said that the ECB is monitoring the outbreak carefully and will still determine whether it will cause a long-lasting shock. Calls, though, are growing for the Fed to step in as coronavirus continues to spread. My colleague CNBC's Steve Leisman takes a look now at how soon that might happen.
Pressure's growing on Fed Chairman Jay Powell to react to the mounting threat of the coronavirus. It's coming from former Fed officials, from the president, of course, and especially from markets. Markets are now pricing in a 68% chance of a rate cut as soon as March. March was not on the table as recently as yesterday. A second cut now priced in with a 66% probability for June, and now a third cut with a 53% probability for September. Yesterday, former Fed Chair Janet Yellen suggested she was concerned about a recession, but that was not her base case. And former Fed Governor Kevin Warsh called for immediate, coordinated global rate cuts. In a commentary in the Wall Street Journal, he said the Federal Reserve should lead the world's central banks in taking immediate action. The window to contain the virus inside China has long since closed. The window to mitigate its effects on the global economy remains open, but not for long. Speaking in Mexico City today, Chicago Fed President Charles Evans said it would be premature for the Fed to give any guidance on monetary policy until it has more data. But he added if the Fed sees something that requires adjustment, I'm confident we will give it all the consideration it needs, he said. With only a few rate cuts in his arsenal, Fed Chair Jay Powell faces a series of daunting questions. Should he act preemptively before the effects of the virus show up in the data? And whether cuts would do much good in the face of a problem that, at the moment, is a supply problem from China. Steve Leisman, CNBC Business News.
Well, Manish Singh, the Chief Investment Officer from Crossbridge Capital, is still with me here. And Manish, we were talking just a few minutes ago about what the coronavirus outbreak could mean for the election in the US, in particular when you're talking about Bernie Sanders' campaign, a man that supports the concept of universal health care. We've heard from the US president this morning talking about his efforts to try and stem the outbreak in the United States and how he still feels like he's being blamed for the fact that it has spread there. Does this become a huge political football in countries, including the US, do you think? Is this something that political opponents will try and make hay of in countries like Germany, let's say, maybe even the UK, if this continues to spread? And is that helpful when you're an investor looking at the situation?
I mean, I think with the US, we shouldn't be surprised because they've been having this spat for all of last 3 years. So I don't think Europe will fall down the same line. It's sad because at this time, they should be working together. And clearly, Mr. Trump will be really worried that this could affect his chances, given that he was doing so well so far. So one has to take note of that. I do mean that Sanders getting ahead in the poll, and if this becomes a poll issue, is problematic because his policy is about anti-fracking, he is about free health care, getting rid of tuition fee or getting rid of student loan. So that is going to be seen as very anti-market. So if that was to, but having said that, America has a history of fighting communism. So I'm not as much concerned about that. Even you will have some Democrats come around to really not see that, Sanders really becomes the president. And a lot of them have said that they're going to do things to oppose him. So it's too early to say. You never discount. I mean, when you do investment, you think in terms of probability, and there is nothing has zero probability. I think there is some probability for him to do well. So the market will start looking into it. However, when the debate comes in, Trump has a lot of things that he can get back to Sanders on about his time in Soviet Russia, all the videos he could play, how he praised Soviet Russia before it collapsed in 1988. So I think there are lots of things that he could also do. So I wouldn't be too worried. But of course, the picture and everything, when you have the generation Z and millennials, they want communism, and the Axios had a poll, Harris poll published in Axios last year, which said that 38% of them, they wouldn't mind or they would rather like, then I think that is worrying. So I do have a sense that, maybe in coming years, America will have a bout of socialism to just get rid of this notion that, you can have everything without any cost.
You said earlier, I just want to come back to the markets. You said earlier that you didn't see the point in buying US Treasuries at the moment, given the height of the size of their yield right now. How are you positioning yourself around this outbreak?
Okay, so I would say if you're running an asset allocation portfolio, then you have a space for a bond, and then you have to buy. What I'm saying is that if you're running purely for risk purposes, if you buy US Treasury, which is paying you to 1.27%, where the government has told you that the inflation target is 2%, so they're going to debase your money by 2%. So if you think that you're buying at 1.2, lending the government at 1.2% for 10 years, and they're going to debase your money by 2% per year, I mean, that's shocking, right?
What would you suggest instead of that, then?
So my view is that you buy blue chip stocks. I mean, I believe in human grit and ingenuity, that they will do well. And it's not the first time we've had this crisis. So there is an overreaction because this is a global one, in the sense that you are seeing pictures on screen and pictures have huge amount of effect. If you had the same thing in 1934, the New Deal would have never worked. Because nobody would believe that anything could happen out of it. But it was that time the president who really stepped up and did the New Deal. It was not the rate cut, which a lot of people believe in. I don't think rate cut is one of the means, but that is not going to take us out. It has to be government response and solidarity, and government really coming together and using fiscal response if need be. It's a confidence-building measure. It's nothing to do with something else. The number of deaths are far less than what you have in winter flu. Even in America, those numbers are much higher. Now, there's a perception that it could go bigger. And that's what market is trading on. Of course, you had a good rally last year, so that gives you another reason for market trade on. And then you have elections, and it seems that Sanders could be the nominee by next Tuesday if he sweeps the Super Tuesday. So those things are coming into play. So I don't think it's just about virus.
You mentioned the rally last year, Manish. Thank you so much. Really appreciate it. Manish Singh, Chief Investment Officer from Crossbridge Capital. Of course, when you look at the markets in the US, they're back to many of the levels that they hit only in October. So it's worth bearing that in mind in terms of the context. Let's take a look at the markets here in Europe, though. Of course, a lot of red still on that board for the Stocks Europe 600. Is down 4% at this stage. If we look at the individual major indices behind some of those numbers, you can see where that pain is being felt the most. It looks like Germany down 4.5%. The FTSE 100 has come back very slightly. It's still down 4%. A similar story in Paris with the CAC 40 And in Milan, the FTSE MIB is trading down 3.4%. Individual sectors here, you can see all of those trading well into the red across Europe here this morning. And we look at the US futures before we go briefly. You can see a very negative start to the day, especially on the Dow Jones being called down 700. That's it for today's show. I'm Bill and Marks, Worldwide Exchange. Up next.
Rising energy costs are frustrating. Electricity rates continue to increase, and there's no relief in sight. It's also smart to prepare for power outages that can leave you in the dark. You need a solution that will help you save money, prepare for power outages, and help the environment. Introducing the Generac Power Cell, a battery storage system that harnesses the power from the sun to help reduce your electric bill and provide backup power during utility power outages.
With the battery storage solution, we're saving about $450 a month.
PowerCell's revolutionary technology captures and stores electricity either from solar panels or the electrical grid. It allows you to use stored energy during peak demand times when electricity costs are high, which helps reduce your electric bill, saving you money. And when a power outage occurs, PowerCell is ready to supply backup power to your home. PowerCell's modular design allows for easy customization for any home or budget. And PowerCell is backed with a 10-year limited warranty.
It was a simple installation, very neatly installed. It was done very quickly and efficiently. Since installing our power system, we've been experiencing a savings of $1,500 a year.
Generac has been a trusted provider of backup power solutions since 1959 and provides 24/7 customer support.
The battery storage solution in combination with the solar has been one of the best investments we've ever made.
Special financing is available with low monthly payment options. You will likely qualify for tax credits and energy rebates, which could save you up to 30%, adding to the savings you'll enjoy over time with PowerCell. Call now to schedule a free in-home assessment. The call is free, the assessment is free, and there's no obligation to buy. Act now to receive PowerView, Generac's home energy monitoring system, a $300 value. With PowerView, easily keep tabs on your energy consumption, monitor your battery usage, and track your savings. Don't wait. Call or go online now. PowerCell, savings powered by the sun.
Do you worry about going to the dentist? Well, relax. The Carefree Dental Card is now available in your area. Call the number on your screen and we'll send your actual card at no cost today. With the Carefree Dental Card, you go to the dentist whenever you need and you instantly pay a lot less. The Carefree Dental Card is just $15.95 a month. So call now and make going to the dentist carefree.
Call 1-800-478-0809 to receive your free Carefree Dental Card information kit.
We are the dreamers.
We changed the world.
Because we don't give up.
IU can help you live your dream.
IU is an online college, so your campus is wherever you want it to be.
Take classes when you want to take classes.
You receive the tools you need at no extra cost.
Even a brand new laptop and tablet to use in school. Call IU, then tell them your dream.
1-800-967-1179. 1-800-967-1179.
The biggest problem that we're helping address is access to care. Doctor on Demand is available nights, weekends, holidays, on a mobile phone or on a website. So much of the value that telemedicine can bring is empowering patients to seek care when they need it. The opportunity for our overall healthcare system is to deliver all the healthcare virtually that can be delivered virtually. That'll reduce costs, increase quality, and drive satisfaction for the doctors and the patients. This is the future of business. I watch CNBC.
Market rout. Wall Street suffering its biggest one-day point loss ever, and stocks are now on track for their worst week since the 2008 Great Financial Crisis. It is February 28th, 2020, a Friday, and Worldwide Exchange begins right now. Good morning morning and welcome to the show on this very tumultuous week for the markets. I'm Dominic Chu. Joining me on set for the entire hour, JP Morgan Private Bank's Anastasia Amoroso. Also, Jenny Harrington, Gilman Hill Asset Management CEO. She is also a CNBC contributor. But we begin this morning with breaking news. Nearly 90% of the S&P 500 is now in correction territory, what traders call a move of 10% or lower from recent 52-week highs. Now, futures right now are pointing to more losses this morning as all the major averages look to push deeper into that so-called correction territory. As you can see here, if these futures moves hold, the Dow would open down by around 620 points at this stage, and a massive move, again, volatility to the downside for the Dow Jones future, even on an intraday basis. We are currently just off our worst levels of the session so far. Now, checking treasuries, yields on the 10-year treasury note and long bond, the 30-year bond, all trading near record low yields. Currently, the 10-year note yield 1.19%, so now below 1.2. 30-year treasury long bonds 1.69%. And by the way, of note, 2-year treasury note yields now below 1% as well. We are seeing red arrows across the world as the major averages in Asia enter their so-called correction mode. Europe also getting hit equally as hard in early trading as well. We'll spin that globe over. Not a speck of green to be seen. We have global team coverage this morning. Matt Taylor in Singapore with the latest there, and Steve Sedgwick is in London. And Matt, we will begin with you in the overnight session in Asia. The rout continued there as well.
Absolutely, Dom, a rough day. Many markets, as you pointed out, entering correction territory when we saw those declines today. Falls right across the region in the order of about 2 to 4% as those virus cases outside of China, of course, diagnosed. The Australian market, one of those falling into correction territory, down by about 3%. Neighbouring New Zealand, down by about 1.5%. But then after the market closed, that country reporting its first coronavirus case, and we saw the Kiwi dollar absolutely plunge by more than 1%. The South Korean market down by 3.3%. This week alone, down by about 8%. Japan's market, though, down by 3.7% at the close. This week alone, down by 9.6%. And we are also in correction territory when it comes to the Nikkei, off by 805 points. It was the biggest one-day plunge since December 2008. This market at its lowest level since September. The yen, 108 is where we're sitting now. Money flowing into the safety of the Japanese yen. So we're seeing that strengthening, not helping out the market. China, the underperformer around the region today. Let's give you a look at the Shanghai Composite. We were down 3.7%, 111 points. But when you look at the week, the China market's holding up okay, down by about 5%. Hong Kong also in correction territory, 648 lower, 2.4%, down 12% off of its peak, but this week down by around about 4%. Dom, back to you.
All right, Matthew Taylor live in Singapore with the latest on the European action. Now let's turn to Steve Sedgwick. He is by in London now. And again, red there as well. Specific focus there on what's happening with Germany. New developments there too, Steve.
Yeah, North Rhine-Westphalia is the area of the country that everyone's looking at in Germany now. Concern about having contagion from various towns that have confirmed coronavirus cases as well. But what is absolutely fascinating is we are seeing indiscriminate selling, Dom, on all these markets, on every single sector as well. There is an intellectual debate going on about, is the market oversold? Are we getting big oversold indicators, or actually should we stand aside? But of course, those people who think we're oversold are not clearly getting into the market at the moment. A look at the FTSE 100. It is currently down for the week, around about 11%. The Xetra DAX, even worse, as we mentioned, Germany there, down 13%. But I've been speaking to a lot of companies this week, companies who aren't even seeing any effects of coronavirus, but the market is ignoring them and selling down. For instance, I spoke to the world's biggest brick maker today, Austrian company called Wienerberger. The CEO told me no sign of coronavirus in their trading operations yet, and yet the stock, like every other stock in Europe, getting sold down aggressively. Let me show you by sector as well what I'm talking about as well. Defensive sectors. Well, food and beverage, historically, as we all know, both sides of the Atlantic, has been seen as a defensive sector. But people aren't looking at the defensive attributes. They're looking at sales to areas where, of course, there could be further infection in coronavirus. So you've got the best performing sector in Europe is down 3% today. Household goods, retail, also down by a similar margin. But Dom, the sectors that are really getting it, resource sector today down 5%. And we've seen what's happened with the beyond correction bear market we're seeing in energy, and travel and leisure. Some of the biggest airlines in Europe are down over 20% for the week so far, Dom.
All right, Steve Sedgwick live in London with the latest on the European trade. Thank you very much. Now, the global sell-off, of course, linked to growing fears around the spread of the coronavirus. More than 83,000 people in at least 47 countries are now infected, with more companies warning of hits to their earnings. Frank Holland is here with the latest developments on that front. Good morning, Frank.
Hey, good morning, Dom. That's right. More than a dozen countries in the last 48 hours reporting their first confirmed cases of coronavirus. Now, World Health Organization officials for the first time are saying the outbreak indeed has, quote, pandemic potential. Also, according to results from a new CNBC Global CFO Council survey, 40% of the world's top financial officers say the outbreak has caused a, quote, major decrease in demand from China. A majority of those CFOs saying the virus has created supply and or demand disruptions in their business. And late yesterday, Moody's saying if the outbreak turns pandemic, investors should brace for a global and a U.S. recession in the first half of this year. As you said, the parade of corporate responses continuing this morning. British Airways owner IAG out with comments the virus will hit earnings this year, but it does not know by how much. Airlines have been hit especially hard since the start of this outbreak. Shares this morning of IAG down more than 7%. Dom, back over to you.
All right, thank you very much, Frank Holland, for the latest on the coronavirus details. Joining me now on set this morning, Anastasia Amoroso and Jenny Harrington. And perhaps let's just start first of all, and I'll start with you, Jenny, on this. What exactly happened yesterday? I mean, we were down big, and then it seemed as though dip buyers came in. We got down to maybe only down 200 some points on the Dow, and then it just accelerated into the closing bell. What exactly was the playbook there?
So it was interesting. I think Steve, who was just on, used a really important word, which is the selling's indiscriminate. And so what I thought happened yesterday was very much hearkening back to kind of that December 2018, where when we saw then, it was emotional selling. We got program algorithmic selling, we got capital call selling, and the market just imploded. And when it becomes indiscriminate like that, you know it doesn't really have to do, in my opinion at least, with coronavirus. Because to his point on the brick making company, there is no relationship between this virus and how bad things are going to be with it. And by the way, we'll get into this later, but Anastasia's company put out a really great report that shows the cohorts who are actually in the mortality rates. And you look at that and you're like, this is bad. It's sad. It's a loss of human life, but it's not that bad.
Well, speaking of Anastasia's company here, JP Morgan has joined the ranks of other companies out there, including Goldman Sachs and Citigroup, calling for little to no earnings growth this year, linked directly to the widespread cause of the coronavirus. So it may not be that brick makers are feeling directly affected by it, but the global economy could be slowing down and companies could make less money.
Yeah, look, we absolutely have to account for that. So, for example, we have revised our earnings estimates down from 180 to 174. But by the way, we're still expecting us to hit a 3,400 target by the end of the year. You know, to the point about what happened yesterday, this is so much more about liquidity and the technicals rather than the fundamental.
Explain what you mean by that. When you say liquidity, does that mean or imply, because we talk about liquidity in the sense of the Fed and central banks putting a lot of money out there, but liquidity also means trading liquidity and how much people are actually transacting and how much it can actually move a market to have less people participating.
That's right. So I'm specifically talking about trading liquidity here, and we will look at the E-mini futures, for example, when we look at the number of contracts that are on offer at any given time. Yesterday, we hit the second lowest levels by that liquidity measure since January of 2007. So if you talk about, you know, the lack of liquidity, and then on top of that, you add the systematic selling that we've seen from CTAs, we broke through some really key moving averages yesterday. So that's why you've seen the wave of CTA selling. Then as the VIX spiked to 39, that means the volatility targeting funds are going to have to delever as well. And then you couple that with some of the fundamental catalysts, which we've seen, which is lower earnings. That makes it for a pretty bad market day. And so the thing that I'm concerned about, you know, in the very near future is that we have now broke down below 3,000, which is a long-term key level for the CTA. So we could see another wave of selling. Case in point, we're seeing it this morning, kind of, you know, go through the market here.
So I mean, Jenny, you run an asset management firm.
Right.
You have to make a buy or sell decision. We talk about these commodity trading advisors. These are computer models that are developed to kind of track trends in the marketplace. They're algorithmic by nature. They hit certain levels, certain if-then statements happen, and then they go into buy or sell things. Does it worry you right now that the market dynamic is driven so much by what's happening with just levels being hit and then it causing buying or selling? Does that mean that investors have to then not pay attention or pay attention more?
This is where I think you differentiate trader versus investor, or how I also can frame that is short-term versus long-term. So if you're short-term, yeah, you should be worrying. If you're really long-term, like I am and like my clients are, you really don't need to worry. I know that sounds crazy. I know it sounds callous when the market's down 12% in 6 trading days. But if you have a strategy that was put in place a year ago, 2 years ago, 5 years ago, 10 years ago, and that strategy is set up to help someone meet their needs, then it's obviously anticipated these kind of events because they just happen. So then you kind of don't need to worry. And that whole buy-sell decision is only at the margin. It's just with new cash.
All right, so we're going to have much more in this conversation throughout. Stick around, you all hour they're going to be here. When we come back on the show, much more on the global market rout and the meltdown, plus the moves you should be making as stocks fall deeper into so-called correction territory. Plus, Anastasia over here, right next to us, reveals JP Morgan's 2020 mega trends, the sectors and industries you need to watch. And as we head out to break, here are some of the biggest Dow losers in the pre-market so far. Boeing down 4%, Goldman Sachs down 4%, Cisco Systems down 4%. Worldwide Exchange is back right after this.
When I lost my sight, my biggest fear was losing my independence. So I've spent my life developing technology to help the visually impaired.
We are so good.
We built a guide that uses IBM Watson.
The library is in 40 meters.
To help the blind. It is already working in cities like Tokyo.
Your gate is in 50 meters on the right.
My dream is to help millions more people like me.
Whether you've enjoyed the legendary terrain in Telluride, the unparalleled landscape of Park City, or the famed peaks of Whistler, you face the hassle of lugging your gear through the airport. With ShipSkis, you're just a few clicks away from having your skis, snowboard, and luggage shipped from your doorstep to your destination. With unrivaled pricing, real-time tracking, ShipSkis delivers hassle-free. Ship ahead and go catch those first tracks on fresh snow. ShipSkis, your skis delivered.
Seeking safety from the sell-off. Finance expert Jeremy Siegel. Where investors are turning now as global markets hit correction territory. Squawk on the Street, 10 a.m. Eastern today. Watch and listen live on the CNBC app.
Do you have enough cash to buy something in the weakness, or do you need to borrow money to make that happen? If you don't have a decent amount of cash on the sidelines, you shouldn't do any buying. If anything, maybe do some selling the next time you get a moment of strength. Watch or listen live on the CNBC app.
Life Room by Four Seasons, where outdoor living meets future technology. No matter your style or budget, Four Seasons has got you covered. Simple shade from the sun? Covered. Outdoor dining in style? Covered. Need additional living space? Oh yeah, that too. Call today and arrange your free design consultation. Four Seasons, we've got you covered.
We are the dreamers.
We changed the world.
Because we don't give up.
IU can help you live your dream.
IU is an online college, so your campus is wherever you want it to be.
Take classes when you want to take classes.
You receive the tools you need at no extra cost.
Even a brand new laptop and tablet to use in school. Call IU, then tell them your dream.
1-800-967-1179. 1-800-967-1179.
Continue to resist, as hard as that is, to simply buy the dip because it has worked in the past. There'll come a time not only to buy the dip, but there'll come a time to buy the markets that have lagged. Just not at these valuations yet.
Now, I don't think this is a time, in general, based on fundamentals, that one should have more risk than usual.
All right, those two voices you just heard. The first one, Mohamed El-Arian from Allianz, a very familiar voice on this network. Then Howard Marks at Oak Tree Capital. Two very important investors highlighting some of our continuing coverage of the global market meltdown here on CNBC over the past week. Still with me on set here, JP Morgan Private Bank Head of Cross-Asset Thematic Strategy, Anastasia Amoroso. Also Gilman Hill Asset Management CEO and CNBC contributor, Jenny Harrington. Let's talk a little bit about those particular sound bites we just heard. because they both sound very cautious. They both sound like, hey, this is not the time to be jumping in here, even though markets are down to their worst levels for the Dow, the biggest loss since the great financial crisis. And I guess, Anastasia, we'll start with you here. What exactly is then the feeling or sentiment for investing right now?
Yeah, look, there's some both great fundamental and technical damage that has been done to the markets, and the two voices that we just heard, I think, express this fundamental concern. The reality is, as the new cases are abating in China, they're picking up elsewhere in the world, and we just don't know how much, how fast, and how negative this is truly going to be for markets and the economies. We don't know if this is a 1 or 2 month event or if this is several quarters type of an event. So this is why, from a fundamental investor perspective, this is probably a market that you want to stand back and not get involved. But I have to couple this from the technical side, and we're now seeing such extremely oversold levels on a variety of different indicators, whether it's stocks or whether it's rates. You know, you look at the VIX, it's spiked to 39, and typically, when you have these massive VIX spikes, this has marked a point of capitulation. So we're starting to get some pretty attractive, I think, short-term bounce back levels. The other thing too, we talked about liquidity and we talked about CTA selling, and they sold a lot. And even though there could still be another little wave of selling here for longer-term CTAs, they don't have as much to go. We came into late January, February with positioning for CTAs and hedge funds that was quite stretched. So I'm not surprised that we're seeing this big unwind, but at the same time, there shouldn't be as much to go.
So Jenny, we should note right now that we don't often bring up the VIX or the CBOE volatility measure for the S&P 500, but it pays right now to look at it because it did reach the highest level since February of 2018. Anastasia used the word capitulation. Mm-hmm. Is this capitulation, or could there be even more before we see a true capitulation?
Okay, so I was wrong yesterday. I thought we were at capitulation when the market was down 850. So maybe not the best.
You weren't the only one, by the way.
No. I actually did see real time a couple of those kind of really capitulating conversations, and I had those yesterday, and they to me were identical to the conversations that I'd had on December 24th, 2018. So I think there could be more, or maybe this is the moment, but I think we're around it. It is really a bloodbath. But I just want to get back to one thing Howard Marks said. So Howard Marks said, you should not take more risk than usual. And I think that you need to really look at the language on that because it's more than usual. If you're already, let's say you already have 85% of your portfolio in equities, wouldn't that imply that that's just fine? And then Anastasia said something, which was, now is maybe when you want to stand back and not get involved. But that's not reality for most investors, especially retired people, because they are involved. And maybe they have a portfolio that has income production that they rely on.
Sure.
It has capital gains that they rely on. So you really need to think about each individual situation in this.
Yeah. And by the way, I don't think that investors need to stand back. I think, tactical investors, there's definitely things to do here. And you look to the option markets to position for a short-term snapback. Because, by the way, we have this great technical selling, and selling begets more selling at the moment. But if you get a fundamental catalyst, if you get better communication from central banks, and by the way, when they're going to be looking at markets like this, something is likely to come on the catalyst.
Jenny, what's the catalyst?
Okay.
So what gets you to say, hey, this is the time we want to be finding things to put to work?
I mean, personally, I'm kind of there. I have stocks in my portfolio that are down 25% in a week that it makes no sense. So for me, that's pure capitulation on individual stocks. One other thing on volatility, I have this bumper sticker in my office that nobody likes, and it says, I love volatility. But to that point in watching the VIX, you do need to, because you know what? In these environments, there is stuff to do.
All right.
Sorry.
Jenny. Anastasia, you'll be with us all out. We got a lot more of this conversation to go here. As we head out to break, though, check out the only 4 S&P 500 stocks, only 4 still positive for the week as of yesterday's close. Yes, Clorox, CME coming off fresh all-time highs. Gilead and Regeneron also trading near 52-week highs. Many of those tied in some way, shape, or form to the coronavirus thesis. Worldwide Exchange is back right after this.
3,225. That's today's big number. It's the amount of points the Dow has lost so far this week.
We can't calculate our total taxes?
Do you realize how many different taxes we pay? Sales tax, different POS systems in all 7 countries.
And online sales?
That's a whole other system. And different regulations. There's real estate credits, solar incentives.
And we have no way to integrate all that.
No, but BDO does.
People who know BDO.
Pain can weigh you down, but you're resilient. And I see how lidocaine patch fuels your resilience. Powerful, targeted pain relief. Pain will not get the best of you. It will bring out the best in you. I see hot lidocaine patch.
You may know Viking for our award-winning river cruises. But did you know Viking is also the best at sea? Voted by readers of Travel and Leisure 4 years in a row. Discover fascinating destinations and enriching activities on our elegant ocean ships. Designed for just 930 like-minded travelers. Viking, exploring the world in comfort.
Selling on Poshmark is crazy simple. All you have to do is post a picture, add a description, add a price, and you're pretty much good to go. Right now I'm selling Air Jordans and Nikes and Adidas, anything really performance related or style related.
Download the free Poshmark app now.
I've pulled your credit and I've got some bad news. We're gonna pass on that loan.
What? You just said a second ago I was fine.
Oh yeah, that was before we saw the negative items on there.
Wait, negative items? That doesn't sound right.
You know, it's like they say, bad credit is forever.
That sounds made up. Kind of like these items on my credit.
Well, just because you haven't heard of it doesn't mean they don't say it.
They say a lot of things about credit. We say enough is enough. Try something new, starting with a free credit evaluation from creditrepair.com.
A lot of folks ask me why their dishwasher doesn't get everything clean. I tell them, it may be your detergent. That's why more dishwasher brands recommend Cascade Platinum, with the soaking, scrubbing, and rinsing built right in. For sparkling clean dishes the first time. Cascade Platinum.
Do you have concerns about mild memory loss related to aging? Prevagen is the #1 pharmacist-recommended memory support brand. You can find it in the vitamin aisle in stores everywhere. Prevagen, healthier brain, better life.
Welcome back to Worldwide Exchange. Let's get a check on some of the stocks on the move so far this morning. Beyond Meat's fourth quarter revenues blowing past Wall Street's estimates, up 212%, but the company reported a loss just 1 quarter after posting its first profit. Beyond Meat citing temporary disruptions related to expanding production in places like Europe and Asia. The company's executive chairman, Seth Goldman, announcing on the earnings call he's stepping down from that role to be non-executive chairman. Those shares, by the way, off 15% pre-market. VMware's fourth quarter adjusted profits fell short of forecasts, even though revenues did beat. The cloud software maker says higher sales and marketing costs weighed on its earnings. Those shares off nearly 7% pre-market. And then AMC Entertainment reporting a fourth quarter loss, but adjusted profits did beat analyst forecasts. Revenues also coming in better than expected. And the theater chain is slashing its quarterly dividend, though, and announcing a $200 million stock buyback as well. Those shares just about 1% to the upside. And well, as we head to break, another outbreak alert. Global K-pop superstars BTS, yes, BTS, we're going to work this into the show. They are canceling several shows in South Korea in April. The group's management says it had to consider the health and safety of the band, production crews, and thousands of concert goers. So BTS, the latest casualty of the coronavirus scare. Plus, Dow Futures taking investors on another wild ride this morning. We can help you navigate through all the turmoil, all those tips coming up when Worldwide Exchange returns after this commercial break.
Don't just plan to retire, plan to live. An annuity helps cover your essential monthly expenses, so you're free to live the life you want. Find out how an annuity can give you lifetime income at protectedincome.org.
Read yourself past the junk, past the hashtags,
And the troll armies, the partisan pandering, past all the social media that's making your head feel like... Past the gossip mags and millions of stories uploaded each day. Read yourself past the algorithms. Because no one ever did anything big by reading small. Read yourself better.
Life Room by Four Seasons, where outdoor living meets future technology. No matter your style or budget, Four Seasons has got you covered. Simple shade from the sun? Covered. Outdoor dining in style? Covered. Need additional living space? Oh yeah, that too. Call today and arrange your free design consultation. Four Seasons, we've got you covered.
If you're living with diabetes, then you understand the difficulties, from painful finger sticks to worrying about highs and lows. If you haven't heard of continuous glucose monitors, listen closely. A continuous glucose monitor is a breakthrough technology that reduces finger sticks and warns you of dangerous spikes in sugar levels. If you meet these requirements, you may qualify to receive a CGM from Solara. Solara, your single-source solution for better diabetes care.
Welcome back to Worldwide Exchange. We've got mega losses for the so-called MAGA stocks this week. Microsoft, Apple, Alphabet, the parent company of Google, and Amazon combined have lost more than $720 billion worth of market value as those stocks continue their slide. We are back on the show right after this break.
My WW's been an amazing journey. It's almost like a challenge every day to see how well I can eat and still enjoy myself all day long. I wake up every morning to see how much weight I've lost and how much better I look.
My WW. Join for free and get 3 months free.
When you really philosophize about it, there's only one thing you don't have enough of. Time is the only truly scarce commodity. When you come to that realization, I think it's very important that you spend your time wisely. And what better way of spending time than traveling, continuing to educate ourselves and broaden our minds.
Viking, voted #1 by both Condé Nast and Travel + Leisure readers. Learn more at vikingcruises.com.
A hard 20 after a hard day isn't for everyone. Waking up before the sun isn't for everyone. This isn't for everyone.
Peloton, let's go.
But at $58 a month,
Don't give up. Come on.
Peloton is for anyone who wants it.
For drug-free sinus and allergy relief, experience Navage.
This time of year, I get so stuffed up, but Navage flushes my sinuses so I can breathe again.
Navage uses powered suction to flush out allergens, germs, mucus, and dirt.
My doctor recommends Navage to breathe better through my nose, and it works. Congestion's gone, and I feel great.
And Navage is so much easier than a neti pot.
Trusted by happy noses everywhere, Navage is nature's decongestant. Online and at these fine retailers.
Want to freshen your home without using heavy, overwhelming scents? Try Febreze One. It eliminates odors with no heavy perfumes, so you can feel good about using it in your home. For a light, natural-smelling freshness, try Febreze One.
Ambition lives in our DNA. Competition coursing through our veins, consuming us with a need to thrive. It's just part of who we are.
How's the IT department liking the Now platform?
Every time it takes care of something for us, we celebrate.
How often does... Got it.
ServiceNow, the smarter way to workflow.
A global stock rout. Futures taking investors on a very wild ride as major markets around the world fall deeper into so-called correction territory. Wall Street coming off its worst point loss in history just yesterday as investors look to cap off the roughest week since the financial crisis. It is Friday, February 28th, 2020, and the second half of Worldwide Exchange begins now. Welcome back to the show. I'm Dominic Chu. With me on set for the entire hour so far, JP Morgan's Private Bank's Anastasia Amoroso, also Jenny Harrington, Gilman Hill Asset Management CEO. She is also a CNBC contributor. Well, we are kicking off this half hour with breaking news. Nearly 90% of the S&P 500 is now in so-called correction territory, down 10% or more from recent 52-week highs. Wall Street is coming off its worst single-day point loss, as you can see here in history. We finished down nearly 1,200 points on the day. Futures pointing to more losses this morning. As you can see here, all the major averages look to push deeper into that correction territory. By the way, the Dow indicated to open down 440 points. That's about a 250 to 300 point improvement over where we were just about a half an hour or so. So we'll keep a close eye on that. The S&P down by 50 points implied open. Now checking the Treasury side of things as well. Look there, because we are seeing moves lower towards record lows for the long bond and the 10-year Treasury note yield. That 10-year note yield currently below 1.2%, 1.199. The 30-year long bond, 1.705%, and 2-year notes of note right now below 1% as well, 0.984% yield, the last trade there. We are seeing red arrows around the world as well. You can see here the major averages in Asia are also entering their so-called correction modes. The Nikkei in Japan, Hang Seng, and the Shanghai Composite all hit equally hard in trading, as you can see there red across the screen, and the European trade as well. Not a speck of green to be seen anywhere on the global map today. We have global team coverage this morning. Matt Taylor is live in Singapore, and Willem Marx is in London. And Matt, we will begin with you.
Hi there, Dom. I'm going to start with the China markets, the underperformer around the region today. And in fact, the Shanghai Composite down by 3.7% or 111 points. When you look at this week, though, the China markets have actually been the best performers. Shanghai down by about 5%. Hong Kong down by 2.4% today. This week off by around about 4%. But this is one of the markets in correction territory, down by about 12% off of its recent highs. Japan, it's a different story there. The market also down by about 3.7%, 3.67%, or more than 800 points. This week alone, down by 9.6%. Today is the biggest percentage drop since December 2018, and the market at the lowest level since September of last year. Money going into the Japanese yen now at the 108 handle, which is pressuring the Japanese market. The topic's off by about 3.6% as well. Across Asia, I've got nothing better to report for you. Red from every market. New Zealand, Singapore, South Korea down by 3.3%, 8% this week. Australia also in correction territory, off by about 3.2%. And after the New Zealand market closed, we heard the first coronavirus case reported in that country, and it really sent the Kiwi dollar into free fall, down by about 1%. Dom, back to you.
All right, Matthew Taylor in Singapore with the latest on the Asian trade. To the early trade now in Europe, it's red across the board there as well. Willem Marx is standing by in London. Willem.
Dom, you mentioned just now that some of the US futures actually improving over the last hour or so. It's actually been a similar case here in Europe. FTSE 100, for instance, was down more than 5% at one point this morning. It's down now around 3.33%. We've heard from the outgoing governor of the Bank of England, Mark Carney. He thinks coronavirus will have an impact on the UK economy. Stocks like IAG reporting they're expecting, the airline carrier group, they're expecting to see some adverse impacts as well. In Germany, where the Xetra DAX down nearly 4%, you've got a town called Heisberg in North Rhine-Westphalia. 1,000 people under quarantine after they found 14 cases of coronavirus infection there last night. In France, the numbers of coronavirus confirmed almost doubling overnight. You see the CAC 40 there trading down more than 3%. And in Italy, where you've still got those multiple towns under quarantine, you can see the FTSE MIB in Milan trading around 3% lower. A lot of airlines reducing the number of flights and travel to Italy. That's going to have a massive impact on the tourism industry there in particular.
Willem Marx, notable there that the Italian markets are outperforming some of the developed ones. Thank you very much, Willem Marx, for that update on the European trade. Back home now, futures continue to signal a lower open for Wall Street, with the S&P currently indicated to open down. Take a look at this, though. It took only 6 sessions for the S&P 500 to move all the way from record highs into so-called correction mode. That's the fastest slide from a record high down to correction in the history of the markets for the S&P 500. For more on what this means, we are back with JP Morgan Private Bank's Anastasia Amoroso, also Jenny Harrington, Gilman Hill Asset Management CEO. She is also a CNBC contributor. Anastasia, we're going to start with you here. We talk all about some of the things that you should be doing. How do you navigate these markets? Yeah. What exactly is the strategy now, given the themes that you are seeing develop?
Yeah, absolutely. So short term, I think we're positioning in the options markets, but for anybody looking out 6 months plus, I think there's great opportunities to be adding to on this pullback. And those opportunities for us stand out in the mega trends. These are the trends that are going to change and shape the world for the next 3 to 5 years, and they're not affected by 1 quarter or 2 quarters disruption. So there's 3 particular that I'm talking about, which is digital transformation, healthcare innovation, and sustainability. And so if you think about the sectors that tie to that, of course, it's going to be tech. I would also not overlook China tech as a result of that. I would look to healthcare, which is now trading at a 20% discount to the S&P. And of course, I would look to the sustainability theme with electric vehicles, which has gotten to be, pretty tough in China. But China, again, is recovering, and electric vehicles, they're likely to do better.
How do you express those views? So let's say that those 3 mega trends do end up hypothetically playing out. How exactly do investors capitalize on that kind of a theme?
Yeah, absolutely. There's great opportunities that we identify in single stocks, and we can do this in a variety of different combinations. But for example, within digital transformation, one of the bigger trends within that is actually artificial intelligence. And one thing that really makes AI even more valuable than we already thought it was, think about the role that it's playing right now in actually mitigating and managing an epidemic like coronavirus. So anything from e-commerce to telehealth to actually using AI to decode this coronavirus and look for potential cures. So identify stocks in that environment. We look at 5G and figure out who are the beneficiaries, and depending on where we are in this life cycle.
Now, Jenny, it's interesting we bring up some of those trends. There are ETFs these days that track all of those things. I also know that just in the last couple of days, speaking of the AI health front, IBM, we know that they have a lot of AI initiatives. IBM Watson Health is one of their big ones. They are now providing that service free to certain government organizations and health organizations around the world. One of a number of companies trying to use their resources to combat coronavirus. What types of companies do you look at? What types of industries do you look at with regard to how you can actually kind of overcome some of these coronavirus fears and come out on the other end better off for it?
Yeah, so I feel like Anastasia just served this up for me on a
platter.
I know, thanks so much. So it's really cool because I'm able to, as a portfolio manager, buy the individual companies that benefit from this. And you can buy companies like AT&T that's down 7.5% in the last 5 days and has a 5.9% extraordinarily safe dividend yield. And the whole investment theme on that hinges on 5G, right? Meanwhile, it's just been sold off as if it has no point. And by the way, if people do cocoon and go home, you know what they're going to do? They're going to binge watch. And you can buy companies like IBM that's paid a dividend for 49 straight years and is down 12%. And it's got a 5% dividend yield. So there's a ton of these. I mean, I can even get into the green stuff with dividend yields and long dividend histories if we want to go to sustainability.
So let's do that. What exactly goes on your shopping list, Jenny, as these things kind of develop? We know the themes that are in play. What do you say, hey, if this thing gets to this level, I'm in. Hit the buy button.
Right. So what's on my, I don't own already, and they're on the buy list if they get to this level, are things potentially like UPS and 3M that are just getting bludgeoned, but I don't own those yet. So if I have a portfolio where maybe they've sent in cash or they, I don't know, for whatever reason, they're putting more money to work, the things that are on the buy list that are actively going in right now are things like, there's a company that I own called Hannon Armstrong. It's a real estate investment trust that specifically finances clean energy, carbon reducing emissions projects, right? It's down 8%. It's got a 4% dividend yield. So there are companies like that. There's so much to do. There's CenturyLink, which owns 500,000 miles of fiber. You can buy that. People are going to sit home. They're going to be online. They're going to be doing things.
Sure.
It's amazing. So many opportunities in the U.S. stocks. And I would just point out that let's not overlook the Chinese stocks as well, because after all, that is the place where the new cases are actually dropping and the Chinese economy is likely to rebound most. To your point about gaming and watching those things and using commerce and telehealth, there's a number of China companies. I mean, the beauty about China is it is a more digitized economy than even the U.S. or Europe. So, and China tech, by the way, has lagged U.S. tech massively rally since mid-2018. It's trading at a discount to U.S. tech, whereas typically it trades at a premium. So I would absolutely have that on my buy list.
And people in China aren't sitting home twiddling their thumbs. They're using up the internet.
Sure, they're playing
online.
games and everything else.
Yeah,
I want to get your thoughts on this too, because our very own Jim Cramer has been active on social media, as he often is, especially in times of market stress. This is what he was saying just about an hour ago. He said, he tweeted, when sellers sell everything, including the stocks of companies that do well in a pandemic, to the point you guys are making right now, then you can presume that they are simply making a sweeping false judgment about companies in the asset class. Is this, I mean, the cliche is baby bathwater. I don't know if it's appropriate, but is that the scenario that's playing out right now?
It's such an important point, because what the markets are assuming now is that this is going to last a while, that there's not going to be a recovery in 1 month's time or 3 months' time or what have you. And this is why we're taking down earnings estimates. This is why when you look at the 10-year Treasury, we can extrapolate the implied growth rate from that. It is looking at something like 0.5% U.S. GDP for the next 12 months. That is likely not going to be the case if coronavirus does end up being contained and we have a spring snapback of activity. So, so to your point, this is a great opportunity when we bake in this, this massive prolonged fear. It's a great opportunity to execute the shopping list.
All right. Anastasia, Jenny, stick around. We know you will. You're not going. You're hooked up to microphones right now.
So happy to be here. Not going anywhere.
Don't go anywhere. Coming up on the show, a closer look at one often ignored area of the market that matters a lot to Wall Street and your money. We're going to tell you what that place is. And as we head out to break, a look at the worst performing S&P 500 stocks in the pre-market action so far today. Corning, Freeport-McMoran, Newmont Corporation. Interesting with the gold trade there. Worldwide Exchange is back after this.
I am totally blind, and Non-24 can throw my days and nights out of sync, keeping me from the things I love to do. Talk to your doctor and call 844-214-2424.
Are you stuck with a low credit score causing you to be denied credit? Then do what Terrence did and go to creditrepair.com.
I started thinking about buying a new house, and my score wasn't where I needed it to be.
Don't let a low credit score hold you back.
Knowing that somebody's working for me and fixing my credit and allowing me to still be free to do what I need to do is actually a time saver.
Don't wait. Visit creditrepair.com to see how you can get started with a free credit evaluation and game plan.
Hi, Phil Swift here. People everywhere tell me how much they love the Flex Seal family of products.
This stuff is awesome.
It really works. Nothing compares to the original strength of Flex Seal. Flex Seal Liquid, Flex Shot, Flex Tape, Flex Glue, and Flex Paste. Use the Flex Seal family of products to weatherproof and protect virtually everything. Even make quick repairs underwater to help prevent flood damage. Seal up large cracks and holes to keep those nasty pests out of your home. All Flex Seal products create a super strong watertight barrier. Patch busted pipes, seal gushing gutters. Now you can coat, patch, seal, and repair. And don't forget about our portable Flex Seal Minis, perfect for quick repairs on the go. Imagine everything you could do with the Flex Seal family of products. Available at these fine retailers.
Day 1, 50 Peloton rides to start the year. Here we go. Halfway there, just hit a 5-day streak.
We did not wake up to be mediocre today, Peloton.
It's just another meeting.
Come on, you didn't wake up to be mediocre.
All right, well, the global market sell-off is being fueled in part by fears around the coronavirus, and we are hearing more and more commentary about and reports about the potential impact today. Frank Holland is here with the latest details on those developments here. Frank.
Hey, good morning again, Dom. Saudi Arabia is pushing for deeper production cuts when OPEC and its allies meet next week as the coronavirus outbreak has crippled demand. The Financial Times reports the kingdom is asking producers to agree to a cut of an additional 1 million barrels per day. The Saudis, they would account for the bulk, while Kuwait, United Arab Emirates, and Russia, they would split the rest. The operator of Tokyo Disney is closing 2 theme parks through March 15th to try to limit the spread of coronavirus. Oriental Land says that policy is in line with the Japanese government's request to cancel or postpone big events for 2 weeks. This is the first time Tokyo Disney has been closed for an extended period since an earthquake and tsunami hit northern Japan in 2011. The outbreak also hitting the auto sector. Hyundai has shut down a factory in South Korea after one worker tested positive for coronavirus. The move disrupting production of popular models such as the Palisade SUV. Hyundai is not giving a timeline to reopen that plant. Shares falling 5% today. Dom, back over to you.
All right, Frank Holland, thank you very much for that. Investors are moving away from high-yield debt, riskier assets amid growing coronavirus worries, junk bonds suffering their worst and biggest outflows in more than a year as a result. Now, this is the HYG, that's the ticker, BlackRock's flagship high-yield ETF, losing $4 billion this week alone amidst the increased market volatility. So joining me now is Bill Zox, Chief Investment Officer for Fixed Income and Portfolio Manager at Diamond Hill Capital Management. We are not paying enough attention to this in my mind. This idea that risk is being played out in high yield as well. I just want to look at this because over the last month, that high yield fund has now taken a move to the downside, as you can suspect. But what exactly is driving a lot of that action?
Well, first, of course, is the virus risk, but in the recent days, it's liquidity risk. We're probably in a liquidity recession right now.
So explain that to us, because Anastasia on set brought up the liquidity as well. It is because these types of bonds aren't as easy to trade, say, as Microsoft stock, right?
That's right. You have intense selling pressure in the ETF space, but the bonds, the underlying bonds, are not as liquid. So it's creating an air pocket in terms of the price of these bonds.
All right, so here's an interesting chart. Investment grade versus high yield, return-wise. If you look over the last 10 years, right, high yield is actually doing pretty darn well, outperforming treasuries, investment grade. It's getting a little bit more even here since 2014. And since 2018, September of then, it really has been investment grade that's the real standout and high yield as the real underperformer. Explain to us that divergence. Why are people so much more enamored with investment grade these days than high yield?
Sure, treasuries are the dominant factor here, and government bond yields are at record lows, and that's why investment grade bonds have continued to generate returns this year, while high yield has gone negative over the last few days.
So there has been a divergence developing in the marketplace as of the last couple of weeks, where investment grade debt has been performing so much better than junk rated debt. And you can see here kind of like the moves, double B being junk, triple B being more investment grade. Talk about the divergences that you see. Is this enough right now to signal that a bad time could be ahead for the overall market, given the dynamic in junk bonds and investment grade?
Well, clearly the risks of recession are growing quite a bit this week. For a long time over the last 3 years, triple Bs were very attractive relative to double Bs. But just in the last day or two, double Bs are starting to look more reasonably priced compared to triple Bs. So there's core bonds are still very important in an environment like this, but investment grade corporate bonds might start to act more like high yield bonds from this point forward, because the treasury effect is largely in it. Now you're going to deal with the spread widening.
All right, perfect. Bill Zox, thank you very much for joining us. What are your thoughts on the high yield and investment grade markets? We appreciate it.
Thank you.
All right. When we come back to the show, we'll check out the action since the Dow began selling last Thursday. The total point losses for the blue chip index now 3,579 points in total. And as a reminder, you can always watch or listen to us live on the go on the CNBC app. Worldwide Exchange is back right after this.
Life Room by Four Seasons, where outdoor living meets future technology. No matter your style or budget, Four Seasons has got you covered. Simple shade from the sun? Covered. Outdoor dining in style? Covered. Need additional living space? Oh yeah, that too. Call today and arrange your free design consultation. Four Seasons, we've got you covered.
If you're living with diabetes, then you understand the difficulties, from painful finger sticks to worrying about highs and lows. If you haven't heard of continuous glucose monitors, listen closely. A continuous glucose monitor is a breakthrough technology that reduces finger sticks and warns you of dangerous spikes in sugar levels. If you meet these requirements, you may qualify to receive a CGM from Solara. Solara, your single-source solution for better diabetes care.
Next on Squawk Box, sectors on the front line of coronavirus fears. Which are most vulnerable, and where can investors turn for safety? Squawk Box today, 6 a.m. Eastern. Watch or listen live on the CNBC app.
When you run a con on anybody, even your own mother, that's American greed. All new episode, Mondays, 10 Eastern, CNBC.
Wondering which credit card is right for you? Introducing CNBC Select, the authority on all things credit cards. We do the research, you reap the rewards. Head on over to cnbc.com/select and take control of your money.
When you consider the scale of the epidemic at this point, it's hard to believe that we aren't going to start running into major supply chain interruptions and also start seeing more pressure on earnings and free cash flow. If we can't get this thing contained soon, that is probably sometime this week, then, it's going to come to America. And once it comes to America, then we have an even more severe problem on our hands in terms of earnings and employment.
We don't know how these doubles and triple ETFs are going to work. We don't know how the small businesses in China will be able to finance their businesses with their shutdown with no margin of safety. We don't know what's going to happen in the United States with the global supply chains. That's good. It creates uncertainty. Uncertainty is the way the market should function, and that's what will create the opportunities. And I'm just saying, be patient.
All right, those two voices you just heard were comments from Scott Minerd of Guggenheim Partners and Mario Gabelli of Gamco Investors, all speaking earlier this week during the market turmoil. Let's bring in another voice to our discussion here this morning. Drew Mattis is the Chief Market Strategist at MetLife Investment Management. Anastasia Amoroso of JP Morgan Private Bank, also Jenny Harrington from Gilman Hill Asset Management are still with us here. They've been with us for the past hour, breaking down all of the market action. So let's bring you into the conversation, Drew. This is very much about the global economy and how much impact the coronavirus will have. Will the global economy slow down enough to warrant the kinds of moves we've seen in the marketplace?
I don't think so. I think the global economy is slowing, certainly, and people are going to have to be taking down their growth forecasts. But at the same point, I think a lot, we've seen a heck of a lot of selling, and relative to I forget who you had on earlier, but they were noting that the selling is just kind of completely random. And I think when people are just trying to get liquidity and they're not thinking about what they're selling in order to raise the liquidity, I think that's a sign that maybe things have gone a little too far.
Now, when you say liquidity, again, it's been brought up a lot today. How much do you think the market action has been driven by that liquidity or lack thereof? As opposed to, like, say, fundamental issues with the economy.
So I'm not an expert on equities, but I think there's a decent chance that some of what we're seeing in the equity market is just equities are liquid. And so if you want to raise cash, you go for the liquid asset first. It might not be the asset you actually want to get rid of. You're going to take some time to actually rotate out of the assets you want to get out of, given the liquidity that's available in those assets at the time.
Do interest rates these days, Drew, accurately reflect in your mind what's going on with not just the coronavirus, but the ultimate ripple effects on the global economy? Or is it too central bank intervened and artificially manipulated for it to be a reliable indicator?
So the yields we're seeing now are the yields we would have anticipated seeing if we had a U.S. recession. So our view was that a U.S. recession was coming. It was going to be in 2021. Maybe you're pulling that forward and lengthening the recession a little bit because of the impact of the virus. But, I think it's a little too early to say that this is a done deal. And so you would expect to see actually maybe slightly higher yields, even given everything that's going on.
All right, let's broaden this conversation out. So let's bring in Jenny and also Anastasia as well. Jenny, we'll start with you here on this particular point. One of the reasons why many of the banks, including Anastasia's, have kind of looked at lowering their targets near term and keeping their targets more in check for the market has to do with interest rates. Has to do with this idea that with low rates moving the way that they are and then maybe rebounding a bit, you'll see some price action there. How much do interest rates factor into your thought process for valuing equities at this point?
I would say, if anything, they value it they weigh in a really positive way, right? Because again, as someone who looks at dividend income, suddenly bonds are way less attractive. So if I'm constructing a portfolio, if people are constructing portfolios, then what are they going to get? Like 1%, 1.5%? Suddenly, the 5% on IBM, the 6% on AT&T looks a lot more attractive. So for me, those low interest rates are actually positive.
Yeah, you're also, Anastasia, looking at the credit markets as well. Yeah. And the trade ideas have to be flowing for you because that's what you get paid for. So what exactly are you looking for in terms of how you play this?
That's right. So I'm looking for two things here. So first of all, you've noticed that in the last week, the 2-10 curve has actually started to steepen, which is a little bit counterintuitive because you think flight to safety, the curve flattens. But the reason the curve started to move higher is because you've got expectations for central banks, for the Fed to cut rates now. And so if you think about positioning for, a steeper yield curve, this makes sense from two perspectives. Because on the one hand, if you have this thing that is actually not contained and, the recession scenario is plausible, then guess what? The Fed is likely to cut rates, and that would steepen out the yield curve. On the flip side, if this thing is contained in a month or so time, month or two time, then you could have the yield curve steepen out as well because, to Drew's point, we're going to start to reprice those recession probabilities that are baked in the 10-year yields right now. And so the long end of the curve, the 10-year, could actually go higher. So I really like that. And the second thing is, this is a little bit too late to be adding protection in the equity market.
Sure.
Because where the volatility is in there. But if you look at the credit markets, there is a way to buy protection against wider credit
You're
spreads.
talking about credit default swaps. It's bond insurance in essence.
In essence. And if you look at that chart, yes, the credit default swap spread has widened, but it's not where it was earlier in 2018, and it's not where it was in 2015, 2016. So those credit spreads have been behaved too well. They could go wider.
So, Jenny, we just had Bill Zoggs talking about the high yield markets as well. One of the things that we didn't get to point out was that spreads can widen out a lot more than they already have so far. Does it worry you on that front?
No, I don't think that worries me either. Can I ask Drew a question?
Yeah, absolutely.
Okay, so here's a hypothetical. One of the things that I've thought about so much is as the banks have been lowering their forecasts, a lot of this hinges on assuming that the consumer is going to just shrink and step back. But if people are sitting home and you think about all the bricks and mortar, the reason they're suffering in the first place, right, is because everyone wants to shop from home. If people stay home, do you think there could be a positive surprise on all of this? That actually the consumers continue to spend and actually these super low interest rates mean people are shopping for cars from home and they're going to go buy them later. They're more comfortable buying houses. Do you think that ends up being maybe a silver lining?
I think that works to a point. And I think what you're seeing right now, though, is the concern that that's going to stop working because, the one thing you can't do, and it's the reason why, we don't think the Fed's going to move yet, is because if people are afraid for their lives, they're not going to go out shopping. They're not even going to stay at home and shop. They're going to bunker down and they're going to only buy what they need to buy because they're going to be afraid that they're not going to be able to get to work, that their job isn't going to exist when they get back to work. There are all these fears that then become to come in and impact consumer spending. And I think that's what people are worried about. We haven't seen it yet, but that's the next stage is factories are shut down and then I'm out of work and I don't have the cash flow I need.
All right. Drew Mattis, MetLife, thank you very much. Also to our, in essence, panel guest host this hour, Anastasia Amoroso, JP Morgan Private Bank. Thank you very much. Also, Jenny Harrington, thank you very much for the both of you guys for being here all hour. We really appreciate all those thoughts on what has been a tumultuous week for markets. And that does it for Worldwide Exchange. This morning, Squawk Box picks up all of that volatile market coverage, and it begins right now.
Truly a history-making week on Wall Street. It's not over yet. Stocks getting rocked this morning. The February sell-off intensifying as the coronavirus spreads. The Dow falling 1,200 points yesterday. That's the biggest one-day point drop ever. Brings the total loss for the week to 3,200 points. The S&P
down more than 10% for the week, 12% overall from the highs. That's the fastest ever correction from an all-time high. We're going to help you navigate this steep and sudden market sell-off with insight you can only find here on CNBC. Friday, February 28th. This special edition of Squawk Box begins right now.
Good morning. Welcome to Squawk Box here on CNBC. We are live from the NASDAQ market site in Times Square. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. And with us for the hour is Steve Grasso. He is Stuart Frankel, Director of Institutional Sales. And Steve, it's good to have you here today.
Good to be here.
Folks, let's get right to the markets because the Dow just had its biggest point drop in history, falling 1,191 points. That's 1,300 points this week alone. That's a drop of more than 11%, and in fact, the Dow is down almost 13% from its highs. The S&P 500 had its worst day since August of 2011. And by the way, this is the fastest correction, a 10% drop from the highs in the history of the stock market, happened in just about 6 days. Let's show you where things stand right now. You'll see that the Dow futures at this point are indicated down once again by about 414 points. I've seen numbers as low as 650 this morning. Things have bounced around pretty rapidly. So I would expect that this is going to continue. What we've seen, the volatility like we saw yesterday. Part of the problem yesterday was that big selling that happened just into the end of the session. This morning, you're also looking at the S&P indicated down another 45 points. The NASDAQ off another 140 points. And if you take a look at the Treasury market, that's where things have gotten even wackier. Take a look at what's been happening with the 10-year. This morning, it is trading below 1.2%, 1.186%. We've been talking about historic lows every day, and that's when the 10-year was yielding above 1.2%. So this is something that is really
we need a bounce there, and we had a little one already. I saw lower levels than that one.
Right, what was the lowest you saw?
The lowest I saw was 117. But you definitely need a bounce in those yields. And I think we should, I don't know, I wish on the ticker, I wish we were running the 10. I was looking for it. You know, I think we should run it. This is an important time to watch that, don't you think, Grasso?
It's crazy, but it's a new timeline for us all to look at these rates, to where they are, to look at the global rates. We never thought these type of rates would get to us. And they're still way higher than the rest of the world is at right now, but it's still staggering to look at this chart. And if you look at the long-term chart of the 10-year, it's unbelievable. There's only one way it's been going, but still, nonetheless, it still is a little shocking on a daily basis.
Let's provide a little bit of historical context for all of this. A sell-off like this does not happen very often. Look back at similar four-day routes in the Dow show they are usually tied to an event, usually a very specific event. In 1998, it was the collapse of the massive hedge fund long-term capital and the Russian financial crisis. The Dow then lost 1,063 points, or 12%. Then in 2001, the September 11th attacks resulted in a 1,200-point drop, also a 12% drop then. Then the big one, 2008, the financial crisis, led to a four-day decline in the Dow of more than 1,500 points, and today, it is the coronavirus, and a four-day loss now of more than 3,200, that really was %.
That was a big one for some people, but the big one was 1987, and it wasn't really precipitated by any specific event other than portfolio insurance combined with this vortex of future selling, and 22% in a day. 22% in a day.
But I want to make a point about all of these. In virtually every instance, there was a firewall. And what I mean by a firewall was there was some kind of action that was taken to end the rout. The Fed announced different plans. Treasury, in the case of 2008, announced different plans. Back during long-term capital, plans were made. There were things that there was a piece of news which seemed to provide some semblance of confidence back into the market. And so the question in this instance is, what could that piece of news be? Or do we continue to go south until that piece of news emerges? We're on a Friday. The real question is, are people going to walk into this weekend wanting to hold on to stocks?
Because there could be 1,000 cases.
Because who knows what's going to happen over the weekend?
And I don't want to alarm people. Is going to be worse this week.
But I've already gone past that, and I've decided that this market has discounted a lot already. That's what I'm saying. And even on a Friday, we are now I mean, we're looking at the possibility of having a negative GDP near term, not sometime in 2020, and in China, maybe a flat, like a zero. Or
I feel as if
do you really think that's going to happen?
Look, I can give you lots of optimistic pieces.
Right. This is what was
mild symptoms.
Mild symptoms. I read that and was like, that should be good. Now I know it's spreading it more.
That's the problem is, like, if you have something that has very severe symptoms,
right,
it burns itself out because it kills the host before it gets
the other. You could say Walmart.
But it's still the mortality rate that we're looking at. We're not looking at, with MERS, you had a 35% mortality rate. With SARS, you had a 10% mortality. Ebola's a 90% mortality rate.
Yeah, but
I feel like this market is pricing in.
Look, I agree. I put some money into the S&P 500 yesterday because I thought, okay, this is a big sell-off. But I also think, what happens if you start to see school closures? I mean, it's the human reaction.
But don't you think I think the market already reflects that.
You know you're going to see school closures because if schools don't close, they're going to be on the line. Right. So the whole protocol is you have to have a protocol.
So you tell me, there are notes going out to corporations all over America saying non-essential international travel, ixnay. Non-essential domestic travel, no good. I mean, so then the question is, when does that kind of news roll off?
Well, you got to wait till you hear from the health officials.
When you brought up long-term capital, it's like a hedge fund goes belly up. We're talking about a global pandemic. I mean, it seems so much worse, and there is no magic bullet. I mean, I could envision some type of vaccine, some kind of vaccine, some kind of therapeutic. But I'm trying to look at
lowering rates is not going to do it.
Probably not. We'll have Kevin Warsh on today for 2 hours to talk about the op-ed that he wrote, which is great to have him today. But here's one more thing. Just let me make one more point. By definition, if you go 12% from the highs in the quickest time ever, the market is discounting something really quickly. Mm-hmm. And also, I'm not looking for silver linings, although I think we shouldn't be all gloom and doom necessarily. But short, sharp corrections typically are ones that are eventually settled by regaining a lot.
I absolutely believe there's a hockey stick to this at some point. The question is,
I'm worried about a big U.
No, I'm not worried about that. Actually, I think there's a hockey stick.
You're looking for a V?
You just tell me what.
How long he doesn't know how long the
a hockey stick.
You just tell me what is the thing that's going to flip it. That's what I'm.
But did you ever know what the thing was before?
No, that's tough.
Right?
Not really. In hindsight, you're acting like we knew something that was happening. There was real fear in '87. We had no idea how that was going to play itself out. I mean, when you see, all the Dow components were like single digits that day. I was looking at American Express at $4 a share. My screen. You weren't around.
No, I was in high school. But
it was. Andrew's going to make the joke, how does it compare to 1929? I was not there for 29, but I was there as a stockbroker, just soiling my wares in 1987 under my desk. I mean, it was horrific.
And every time you go through that, you don't know the Black Swan event. And you don't know the white dove event. So you don't know the recovery.
Just looking at some of those numbers, American Express down 18%.
Yeah.
The chart we were just talking about.
All of these things, if you look at these charts for the last week or so, it's pretty crazy how much money has been lost on paper unless you took the losses and actually sold it. I think most people...
The question was, were we trading too high before?
And paper loss.
That's right.
People only say we're trading too high when you have a collapse like this. But this type of a sell-off, long onlys wanted the sell-off because they felt stupid about holding stocks. Shorts always want to sell off. Everyone wanted a better entry point into the marketplace.
Well, you have it now.
You don't know how much.
Andrew, I'm serious. I'm trying to gauge the Friday. We could have 1,000 cases over the weekend somewhere, and you don't want to hold it. But I'm trying to offset that against the perception that this has really been seriously overdone.
If you get another headline, yesterday we had that bounce back.
We're going to get more headlines
because there was a thought to be a vaccine. No, I'm talking about the good headline that rallied us back.
Israel,
right?
Yeah.
So you're going to get a couple of those. Now maybe you get that type of event when you said, "Where's the firewall?" Maybe you get something today, but I would think most people think that you're not going to get the rally back that's substantive on the Friday before what could be terrible news cycle on all the Sunday morning shows.
That's what Jim Cramer was saying last night, too. Is, you don't typically see a turn on a Friday, but we have seen a big slide.
Does anyone, do we believe China when they say that it looks like the severity is lessening and there's fewer cases?
Do you believe China?
If you believe that,
do you believe the medical expert who we had on yesterday, who said, "Look, as they send people back to work, it's going to pick up again." If people, China did the right thing by shutting things down, and as a result,
80,000, if you stopped it somewhere near 80 or 100,000 in a country with 1.2 billion people.
Look, I think the measures China took helped tremendously by really seriously shutting things down. But now they are worried about the economic impact of that and sending people back to work.
I mean, I've certainly, I went to the gym yesterday, and I told a guy that I know there who works there, I said, I hope you've saved some money, because no one's going to be here in 2 weeks. So, I mean, in my own mind, I'm afraid, and I'm discounting the worst case scenario, and I'm not sure that comes to pass.
I also think
all the machines, people sweating on the machines. You think people are going to go there?
No, but I think if you look at it the long term, I think you're right. But I also the reason I put money into the S&P 500.
I'm saying in my mind, I've already discounted. Maybe the market has discounted too much.
You're right. You don't know.
Joe was way ahead of this. He stopped going to the gym 2 years ago based on this pandemic.
I was there yesterday. I just said, but seriously, I mean, all the weights people. I couldn't help but think if you were there, you'd be like.
I wipe things down, but at the same time, it's like this too will pass.
Right.
But that would include movies, restaurants, and we've already had that specter of that happening here, which I think is reflected in these averages.
Did you see the Starbucks, the woman from Starbucks who sent out the note about how they had reopened all the Beijing things? She did it, but she was wearing a mask through it. And I'm sorry, if you got to wear a mask, I'm not going to Starbucks.
381.
But I also think that this is a temporary situation.
The long-term chart, all right, we talked about the 10-year. The long-term chart is down. The long-term chart of the markets is up. On average, the market makes historically 10% per year on average. You get these volatile moments, and you have to say, do I buy into it? Do I hold? And most people hold or buy into it in the long run.
Can we give you a quick roundup of what's been happening with the coronavirus headlines? This is from overnight. Several European airlines issuing profit warnings as a result of travel disruptions. That includes Finnair and IAG, which owns British Airways. In South Korea, Hyundai Motor closed a factory in the city of Ulsan after a worker tested positive for the coronavirus. Tokyo Disney will be closing tomorrow through March 15th. Yesterday, Japan suspended all elementary, junior high, and high schools in the country for most of the month of March. By the way, take a look at shares of Disney, down by about 17% for the week to date. In the meantime, New Zealand and Nigeria confirming their first cases of the virus. South Korea reporting nearly 600 more cases overnight, bringing the total above 2,300. China, in the meantime, reported more than 300 new cases, bringing its total to nearly 79,000. And Germany's government has reportedly quarantined 1,000 people in their homes in the West German town of Heinsberg. This is the type of thing, as you mentioned, Steve, people hear headlines like this and they get concerned, particularly as you head into a weekend.
A lot of this stuff is not the individual investor saying, let me sell everything I have. A lot of this stuff is deleveraging, where you have trigger effects with accounts that have to sell, mass selling program orders. This is not the individual sitting home saying, I don't want to own stocks anymore. You're not seeing that.
It's just that the first 1,000-point day was very unsettling, and then you get a couple of more, and it's incredibly unsettling. But you wonder, when you're doubting you're going to get the first 1,000-point day, if you get 4 of them, or if you're down 4,000 points for the week, aren't you discounting some very serious?
I do think so.
I know it's a Friday, but I'm going to hold out hope.
People aren't realizing how much it is electronics and algorithms that are just triggering off of moving averages, off of whatever average in the overall market says, spits out 1,000 sell orders. And that's truly, unfortunately, that's what happens with the marketplace.
Still 367, but not 600. And we got to keep watching the 10-year.
The 10-year, right.
I mean, I don't know whether I should hope on a Friday for stabilization, but that's what I'm hoping for.
Well, what was concerning yesterday is hearing Gavin Newsom, the governor of California, saying, we have 8,400 people that we're monitoring right now, but only 200 kits. If the CDC could more quickly get those kits out to people for testing, I think that would probably be very reassuring.
And we've talked enough about how much the flu kills every year, and we're nowhere near that. And in China, every day from pneumonia, there's a lot of elderly people that just, it's just, the circle of life, I guess.
If you're healthy, it's like with the flu. If you're healthy, you should not be passing away from this disease. And when you're looking at a 2 to 3.5%,
mortality rate, I think it gets skewed.
2 to 3.5% is a really big deal. The flu kills 0.1%.
It's a really big deal.
So we don't know what the mortality rate for this one is yet. It's the lowest number I've seen. The New York Times had a number today of 0.4%. That's still 4 times what the flu takes.
0.4.
I understand. I understand.
And that's the lowball effort. If it's above 1% or above 2%, I think you're talking about a very serious issue.
It's close to 0% if you're a healthy person. So I get what you're saying. I get what you're saying.
If you have anybody older that you're concerned about, that, and by the way, this has taken people in their 30s and 40s.
I get it. But this is life, right? So you have to figure out how to navigate. I'd rather pick this over Ebola. I'd rather pick this over a host of other things.
Well, Ebola has never made it really to our shores.
Well, it almost did, and that's where we saw the blip in our stock market as well.
But if you try to look at the half full way of looking at it, if it's a very nasty case of the flu, that would make you feel a little bit better, unless it still shuts down a lot of economic activity in the United States, and then
but that again is a temporary. That again is a temporary.
And you could have a snapback.
You know, but I did hear what Joe said yesterday, and it was a very important point. You don't know how many people, if they're underestimating how many people actually have it, that skews the mortality rate.
Right,
So,
but again, the lowest I've seen is 0.4%.
Look at the
VIX, it's
41.
more deadly than the traditional flu, even though the traditional flu is so much more widespread that it clearly kills more people.
All right, coming up, we will have much more on the sell-off. We're going to talk to market watcher Mark Grant. That'll be good right after the break. And focus now turns to the Fed. We've also been kicking that around. If you were going to cut, you probably, I don't know, what if you cut and it doesn't work? Do you wait till Monday and see what happens today? Do you not do it at all because you need the ammo? There's a lot of ramifications. Can you believe we have the guy that some people think Trump would like to replace Jay Powell with? Kevin Warsh will be on for 2 hours. You set this up. It's awesome that we have him. Anyway, he's coming on at 7 a.m. Friend of the show. He hasn't been on a while.
I didn't realize it had been that long, since 2018, October of 2018. But he is a friend of the show, and we look forward to having him here today.
Too young to be so important. But anyway, as we head to break, take a look at the biggest decliners of the NASDAQ 100 this week. Bet you they're pretty big. We'll be right back.
This CNBC program is sponsored by Baird, a strong financial partner for 100 years.
Hair loss was a reminder of my age. Like, is this happening to me now? When I started first seeing results, I got excited. I love my new hair. It makes me feel a lot more confident. The things I love about Roman are the simplicity, the confidentiality, and the fact that it works.
Yes, the first word to any adventure. But when allergies and congestion strike, take Allegra D, a non-drowsy antihistamine plus a powerful decongestant. So you can always say yes to putting your true colors on display. Say yes to Allegra D.
The biggest problem that we're helping address is access to care. Doctor on Demand is available nights, weekends, holidays, on a mobile phone or on the website. So much of the value that telemedicine can bring is empowering patients to seek care when they need it. The opportunity for our overall healthcare system is to deliver all the healthcare virtually that can be delivered virtually. That'll reduce costs, increase quality, and drive satisfaction for the doctors and the patients. This is the future of business. I watch CNBC.
Once upon a time, being middle class meant you could afford to live a comfortable lifestyle. But these days, it often means being up to your ears in credit card debt. If you owe $10,000 or more in credit card debt, here's something that might surprise you. There are secrets that credit card companies don't want you to know. Secrets on how to completely resolve your debt and become debt-free. Imagine the thousands you could save. To unlock these secrets, request free information from Credit Answers. Just call 1-800-388-1267. We're not talking bankruptcy or debt consolidation. This is your chance to settle your debt for a fraction of what you owe. We even offer a guarantee, so there's no risk to call. Unlock the secrets credit card companies don't want you to know. Within 5 minutes, we'll show you how our program works and how much money you could save. Credit Answers, your answer to overwhelming credit card debt. Call 1-800-388-1267. 1-800-388-1267.
The losses this week have been brutal. Obviously, the Dow swinging wildly and ending yesterday with the biggest one-day point drop ever. But, as we pointed out, at these very high levels, a point drop isn't what it used to be, but it's certainly, it shakes the very foundation of what you're doing when you're watching something go down 1,200, especially into the close. We're down about 600 just watching.
Yeah. I have to say, I watched CNBC all day yesterday. I was glued to it just to see what was happening on a moment-by-moment basis.
The S&P down more than 10% for the week, and according to Bespoke, a correction this fast has only happened 4 other times since World War II. Joining us now is Mark Grant, Chief Global Market Strategist at B. Riley FBR. I would like to be having the 10-year note go by more frequently, Mark. Do you think we need a bounce in the yield there before we get any stabilization in the Dow or S&P or NASDAQ?
Joe, I don't see any bounce in yield coming anytime soon. In fact, the 2-year is so low that even if the Fed cut twice at 25 basis points, that's already been impacted in the market. One of the things that I think is the most interesting in this environment is, I deal for the most part with very large money managers and institutions, but I do help some individuals, and I've been able to take profits in this kind of market, and I'll tell you where. Yes, last hour you had some people on talking about that high yield spreads have widened versus treasuries, investment grade bonds have widened versus treasuries, but also the absolute value at the 10-year to 119. I've been able to take some profits in some of the bonds they own because my strategy is half investment grade bonds and half closed-end funds paying monthly, paying over 10%. So I'm taking profits in the bonds right now and freeing up cash without having any forced sales and getting ready at some point for taking some opportunities, but I don't think we're there yet.
We've talked about some of these serious breaks and corrections and sell-offs we've had in the past, and there seems to be a moment in time that in hindsight we can identify. We couldn't at the time, but something that happens that stems the decline or at least changes the sentiment. And I don't know how that happens when you're in the early stages of what could be a global pandemic. Are we stuck with a month or 2 months or 6 months of uncertainty where we're really not going to have any resolution on these issues? And can the market get to terminal price? I don't like to use the term terminal, but can you get to the to terminal pricing quickly? I was kind of making that point that the market's gone down so much that it is discounting, I think, a lot of the worst case scenario already. Some of it anyway.
Okay, Joe, here's my view. You've got to separate, obviously, the most important thing, which is people and their lives and their health. But you got to take that category and put it over here for a minute. Then you got to take what's happening with the coronavirus and look at what it's doing to business and to GDPs all across the world. It is having a material effect. Airlines, travel companies, cruise lines, shipping companies. You can go through a whole litany of companies and sectors that are being adversely affected by the coronavirus, and I don't think that's going to let up any day soon. Well,
Mark, but
sure, you can.
But you got to figure out the duration of that too, because the snapback could be as sharp as the sell-off if it's not something that lasts a matter of years or quarters or whatever. I mean, if we knew this was going to quiet down in the summer, for example, then you could handle 1 month or a quarter of much lower tempered business activity, couldn't you? If you knew that it was going to snap back, you'd look beyond it. It'd be like a special item on an earnings report or something.
Well, Joe, you're right. If we knew that, but none of us know that.
Right.
What we do know right now is that it's having this virus is having a terrific effect on supply chains, commodities. And now the question is, for instance, in China, they're running their money, their cash, through ultraviolet machines because they're afraid that the virus is being, carried on other things besides people. So it could also turn out, in a worst-case scenario, that we find out that boxes, shipping paper, wrapping paper, all kinds of other things, money, are also able to infect people. I'm not making a judgment saying I know this or that. What I'm saying is, at this point in time, and it's so uncertain, that the sell-off in equities, to me, is absolutely normal and should be what's going on. But if you do have some kind of balanced portfolio, or I'm talking with a lot of the big insurance companies I talk to, you're getting a terrific opportunity to sell bonds at profits and redeploy the money. And I don't think anybody's talking about that. All they're focusing on is the carnage in the equity market, which is true. But the silver lining is the bond markets, where you can actually take profits and raise capital and make some money.
Yeah. It's kind of frightening that, if this is a garden variety correction, we've had dozens of 12% corrections that didn't involve a pandemic, and that maybe it needs to be more than 12. I can argue both sides of all these issues, Mark. If we were to stop at 12 with a potential pandemic, it makes you wonder what would cause all the other 12% breaks. And this seems to be more serious than that, obviously. But does it do 20, 25, 30? That's the real fear, I think. I'm talking about a sell-off of a bear market, a 20% or more sell-off. Do you foresee that, Mark? In your... It's all probabilities. You think it's 50-50? We go into bear market territory?
Joe, I think it's probably, if you want a number from me, I think it's 60-40 we go into bear market territory. We had a spectacular year last year in the equity markets.
60-40 we do. 60-40 we do.
We're going to go lower in equities. Bond prices are probably going to go higher. I expect the Fed to come in at some point. I think that I've been on Wall Street 45 years. You see technical corrections, all kinds of things, drops in earnings. This isn't a similar situation. This is a possibility of a pandemic that's affecting not only people in their lives, which of course is the most important, but it's having a huge effect on businesses and supply chains in a wide variety of industries. And I don't think that many people have focused on how dismal it's getting.
How low do you think yields could go if you think bond prices are going to go higher?
I think we could go under 1% on the 10-year. We're already under 1% on the 2- and 5-year. Yeah. Who would have thought that? And the Fed's probably going to have to do something. But even so, as I said, it looks to me like 2 rate cuts are already baked into the market. I think people are, going to anything they can where they get some kind of return. What I really think this is going to hurt here are seniors, pension funds, insurance companies, because of the absolute value, not the relative value, the absolute value. When your yield's this low, how are they going to make any money?
We had a technician on yesterday, and I said, does it really matter what your stupid charts are saying based on a pandemic and something that has nothing to do with charts and support and resistance and it still does. So if you believe that, if you do believe that the market takes into account so many different things that even AI were unable to do that at this point, maybe you can still look at technicals, and maybe it still matters even when you think all bets are off because of fundamentals that are such an outlier, such a black swan. I don't know. We'll see, Mark. But we know where
I think technicals, Joe, have been substantially minimized by this great unknown of what the virus is going to do, not to people, but also to businesses.
You still might benefit from paying attention to some of that stuff. Maybe not. Technicals are good until they don't work.
Well, the issue with technicals, is that no one knows. To your point, no one knows where this pandemic is going to go, how it's going to be resolved. But what we do know are the levels on the charts. And when people want to set their buy or sell programs, they have to set it to a certain level. They can't just set it at the market, or else you have these things go up and down 5 to 10%. So technicals are actually more important now than they would be if you had a fundamental case.
And they gauge how people feel, and people's feelings are still affecting where the markets are headed right now, even though they're based on a pandemic. So maybe it is valuable to some extent. All right, Mark. Thank you.
Okay, a lot more coming up on Squawk Box this morning. Much more on the market sell-off. We're going to talk about the big drop in the FANG stocks. And next, the impact of the outbreak on Europe. As stocks across the continent plunge into correction territory, we will go to London for a live report. We're back in just a moment.
3,225. That's today's big number. It's the amount of points the Dow has lost so far this week.
USAA insurance for members like Martin, an Air Force veteran made of doing what's right, not what's easy. So when a hailstorm hit, USAA reached out before he could even inspect the damage.
That's how you do it right.
USAA insurance is made just the way Martin's family needs it. With hassle-free claims, he got paid before his neighbor even got started. Because doing right by our members, that's what's right. USAA. What you're made of, we're made for.
Pain can weigh you down, but you're resilient. And I see how lidocaine patch fuels your resilience. Powerful, targeted pain relief. Pain will not get the best of you. It will bring out the best in you. I see how lidocaine patch.
Our friends recommended a couple of pros to help us remodel our kitchen. After checking their ratings on Angie's List, we felt really confident hiring them.
Find all the pros you need to know, all for free at angieslist.com.
Guys come in all shapes and sizes. There is no normal erection for everyone, but there is a normal for you. If, like thousands of other guys, you find that your erection doesn't look so normal anymore, it could be an addressable medical condition called Peyronie's disease, or PD. A curved erection with a bump that bothers you is not normal and should be checked out by a urologist. Because you don't have to accept this as your new normal. Find a urologist at learnaboutpd.com.
Can you customize the S&P 500 to meet your client's income objective? Only Sector Spider ETFs can divide the benchmark into 11 investable pieces. This allows you to underweight sectors like technology and overweight sectors like REITs, staples, and utilities. Sector Spiders, write your next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully.
Old Dominion has ranked number 1 in overall performance 10 years straight. Customers trust OD for damage-free deliveries. They like seeing everything in real time with 100% visibility to every aspect of their shipment. Bottom line, OD is number 1 in performance because of our people, who consider every shipment a promise and who never stop working toward perfection. Old Dominion, helping the world keep promises.
Seeking safety from the sell-off. Finance expert Jeremy Siegel. Where investors are turning now as global markets hit correction territory. Squawk on the Street, 10 a.m. Eastern today. Watch and listen live on the CNBC app.
Good morning and welcome back to Squawk Box this morning. We're live from the NASDAQ market site in Times Square. And if you're just waking up right now, take a look at the markets. The sell-off continues. U.S. equity futures at this hour. You're looking right now. The Dow would open down about 440 points. The NASDAQ would open down 127 points. The S&P 500 would open down 45 points as the sell-off continues. This comes, of course, after the Dow had its biggest point drop in history, falling 1,190 points yesterday. The index has now fallen 3,200 points this week alone. And trying to help us make sense of it, we want to look right now at the sell-off in global stocks across the board, major indices across the world falling into correction territory. We want to go overseas right now, across the Atlantic, to Willem Marx, who is in London with more on the big market moves. Willem.
Andrew, so the major European equities, you can see here all four of these major markets across the continent here, well into the red. Not a pretty picture. It was a lot worse just a couple of hours ago, though, I should say. Here in the UK, the FTSE 100 down 2.75%. The outgoing Bank of England Governor Mark Carney talking about the negative impacts of coronavirus. We've had companies like IAG, the airline giant, warning about the adverse effects of the virus. In Germany, you've got a town there under quarantine, 1,000 people after 14 more cases turned up overnight. The Zetrodax down 3%. In Paris, we've seen the number increase of those affected by this virus as well, doubling overnight. That's down 2.3%. In Italy, where we still have around a dozen towns under quarantine, some new cases in Venice, FTSE MIB in Milan, they're down 2.2%. And we look at the sectors across the continent to see where this pain's being felt the most. No surprise, basic resources down 3.6%, big questions about demand. Technology down 3%, big questions about supply chains. And even some of these areas like retail, food and beverage here in Europe, you might think the companies wouldn't be that badly affected. Even they are trading quite significantly down, the sell-off continuing across all of these sectors, guys.
Okay. Willem, thank you for that report. Of course, we're going to keep our eyes on what's happening globally. But right now, I want to focus on what happens next and look at some widely held names that saw some huge moves this week. Our guest host all morning, Steve Grasso, Director of Institutional Sales, and Stuart Frankel, also a CNBC contributor, is going to help us sort of look through some of this stuff. Why don't we start with the long-term look at the S&P? I think we'll probably take a 2 or 5 year look at this just to try to get a sense of where we really are and what we think. Put this in context for us.
Sure. So now when you look at this level right here, obviously these are the key levels you want to watch here. This is that 2350 level in the S&P.
This was just November.
Yeah, right.
Of 19. When people talk about the run-up that took place, everyone, we had this great run in 19, rather. Or I'm sorry, this was November 18. This was November 18. Okay, so here we are.
So when you look at this, to put it in perspective, you had, as Andrew said, you had this tremendous run to all-time highs here. So when you want to see where you can come back to, you have to look at retracement levels. So for me, when I look at this chart, this level, yes, it's important. Yes, you could think about that if really Rome was truly burning. But what you want to keep an eye on right now is the 2855 level, which is your October low. So that's the key. You want to hone in on that level and make sure that level holds.
Why October and not this October?
Because there's a move that started. There's a move that started here, right? But this move is the most recent move. So if you want to pare it back and say, okay, I want to keep a real macro picture and I want to keep it wide open, the retracement levels are going to be more gappy than if you took the move from October. For me, the more significant move starts here. So you have the market move up. This was a collapse. So these are one-off events.
Right.
This is where the real move started higher for me.
We had the collapse here, and then we almost had the rebound. I mean, basically, we were even here.
Right. But if you look at look at this type of decline that you had here. Right. This was a dramatic decline. So these are not just standard.
Looks like that.
It does.
Okay.
It does, right? So, but where did it happen? This happened at these levels. This is happening at this level. So where did we come from?
Right. This was fear that the market was that the economy was going to turn south.
Sure. It was fear. But my point is for you to look at the retracement levels, you have to start from where this next move happened. This move, rear window. This is catastrophic events, 2350 in the S&P.
Okay.
What you really have to focus on is 2855. Look for that to hold. If that doesn't hold, then we could discuss Rome burning again.
Okay. Let's look at the VIX, the gauge of fear, if you will, in the marketplace, and maybe you can help us think about that.
Yeah, so this is just a crazy chart, right? So when you go back to, obviously we're going way back here, these type of things. So when you look at the VIX,
right,
people offset their leverage and their exposure a different way now than they used to set it back when we had VIX at these levels right here, right? This is more of a standard approach. So if you look at where we are in the VIX, we're at 40, 47, and I believe during the financial crisis, basically, you can't really see the level. We're at about 44.
Okay.
So is this a financial crisis level that we're talking about? I don't think so. All right. I don't think anyone can make that case. So where did we come from? Just a couple of months ago, you could have bought the VIX at around $12.
Right.
So where do you think the retracement is here? The important level for that is going to be 25. So I do think that you could see a retracement back because you're looking at retracements. And as I said before, technicals become more important now because people can calculate the 50% moves from the major moves that you've had. And that's what people put there.
Let's look real quick at two different stocks. I want to look first at Apple because they have been hit and hit hard all week. Every day has been a worse situation. How do you think about this from a either trading perspective?
Well, I'm long Apple. So the trading perspective is you want to keep an eye on a couple of levels. So the 100-day moving average is basically 280, right around that level. Okay. And then on the downside, it's 240 if really we have another biting sell-off in the name. It's right here. So basically, you want to see this level hold.
Right.
If it doesn't hold, this is where you load up. I would not buy anymore. I clearly will not buy any more Apple unless it trades to the 240 level. I'd rather see buying on momentum versus buying on weakness. For me to buy more Apple where I already own it, you have to buy it above 280. So I think that's a prudent investment strategy.
Let's see Microsoft real quick before we head to a quick commercial. You're looking right here. I mean, this has been the same story.
Right, so same story. So Microsoft, this is an extremely important level, and it's sitting right on it. So it's the 100-day.
Okay.
So if you look at the 200-day, you go down to 145.
Okay.
So 145 is the level to hold in Microsoft. It's sitting right here. I hope it holds here. Same strategy. I'm long it. I would not buy any more until it trades above 165.
165 is the number to beat, folks.
This is where, so you either buy it on momentum here, and if it trades down to 145, you could buy it on weakness there, but I would not buy it on weakness at 156. You're caught in between two levels, which are momentum and support.
Steve, thank you for walking through all of that. Becky, I'm sending it back to you.
Okay, thanks, Andrew. When we come back, we're going to take a look at which companies could benefit from employees working remotely among virus concerns. Those stay-at-home stock names we'll have right after this. There's a big hint, though. By the way, don't miss our exclusive interview with former Fed Governor Kevin Warsh. That's coming up in the next hour. He's going to sit down and talk with us for 2 hours about what he sees happening just after writing that op-ed piece for the Wall Street Journal where he suggested the Fed should be cutting rates in a coordinated manner with other central banks. As a reminder, you can watch or listen to us live on the go on the CNBC app. We'll be right back.
Interactive Brokers pays 1.06% on idle cash in your brokerage account. Do you know what your broker pays? Most U.S. brokers offer nominal interest in their brokerage accounts. Move your account to Interactive Brokers and start earning interest.
There's nothing standard about you, so get the new standard in home security and automation. Introducing the all-new FrontPoint Home Security System. So simple, you can install it yourself. Control it with your voice.
Alexa, tell FrontPoint to unlock the door with 3791.
And with your smartphone, too. We monitor your home 24/7 from burglaries and emergencies. Visit frontpoint.com and get 20% off plus a free indoor camera.
Look who's cheap now. You are. And millions more just like you with cheapoair.com. Because when you spend less booking your flight, you're free to do more, see more, live more, and save more. So you can start planning your next adventure. Just download, click, or call and save on the best flights.
cheapoair.com.
Go ahead, be cheap.
A new kind of investor is changing things up. With an app that's changing the way we do money. Download Robinhood now.
Day one, 50 Peloton rides to start the year. Here we go.
Don't stop
here, Peloton. Remember why you started.
Halfway there, just hit a 5-day streak.
What's that mean?
It means Daddy didn't quit.
I don't get it.
Almost 50 rides. Boom!
We did not wake up to be mediocre today, Peloton.
Okay, it's just another meeting.
Come on. You didn't wake up to be mediocre.
Well, guys, no school.
Snow day! Yes!
Come on,
Otherwise known as a WeatherTech day.
let's go.
So when the weather turns bad, you can still find a way to enjoy it with WeatherTech's laser-measured cargo liners, seat protectors, and floor liners. And to secure your phone, don't forget the Cup phone. Order yours today at WeatherTech.com, the ultimate protection for your vehicle.
How's the IT department liking the Now platform?
Every time it takes care of something for us, we celebrate.
How often does... Got it.
ServiceNow, the smarter way to workflow.
We were at historic highs 1 week ago.
The dash for safety is on in global markets. There are some very telling names bucking the trend today and rallying despite this sell-off.
How much of this correction is driven by the uncertainty, and how much of this is this market has been looking for an excuse to pull back?
Session lows went down 900, down 1,000, and then down more than 1,100 points.
It's essentially reversing any expectation for earnings growth. It's the fastest the S&P has ever given up 4 months of gains.
Watch or listen to CNBC live on the app.
All right, welcome back to Squawk Box, everybody. If you are just waking up, well, check this out. Take a look at the U.S. equity futures. After the biggest point decline that we've ever seen in one day taking place yesterday, you are looking at the futures down yet again today. We've already seen the Dow down 3,225 points for the week to date. This morning, the futures at this point are indicated down another 426 points. S&P futures down by 46, the NASDAQ off by 125. If you're looking at the S&P, the correction that has taken place here is the fastest in history. 6 days where you're seeing down 10%. That's a huge pullback. Granted, after the market saw a pretty rapid uptick over the last 4 months, we're really just back at levels we saw back in October, but obviously a very important week, one to be watching. We're also watching the yield on the 10-year, which has hit historic lows on a daily basis recently. You're looking right now, it's picked up back above the yield, above 1.2% at 1.208, but we've seen levels below that this morning. 1.17, I think, is the lowest level you saw.
That's the lowest I saw. Might have been actually below that, but what are we? That's progress.
Right, to be back above 1.2%.
Jim's
by the way,
been talking about. It's not bonds. Stocks are following bonds.
Right.
This morning.
Bonds a bigger market. That's where you're going to see more of
but
what
you
happens.
need that to stabilize, probably, and you probably don't need a big, strong up opening today. Do you think, Grasso? Probably.
A head fake, you mean?
Yeah. Right.
I'd rather see what we're seeing right now, where you see the weakness prior to it versus having some sort of a rebound before 9:30, because then everyone starts to get sucked in, and then you have the European close at around 11:30. So that's where you're going to see the fade. If there's going to be another fade, or if there's a strength into the European close, which I don't think there will be, then you could see some sort of a follow through in our.
I'd love to see a rebound, but you tell me what it is that's again.
No, I don't believe you'll see it on a Friday. But the truth is, we're going around this table, and there's not one person who's saying there's going to be a rebound. Yeah, so which makes me think that you could see some sort of a news headline or something coming out regarding a vaccine or regarding some sort of a federal intervention, and that will send the market higher. And the mere fact that no one expects it today makes me think that it could happen today.
And Fridays that have been bad and previous breaks have presaged really bad Mondays, and I think that's a consensus that Monday could be bad, and very few people are thinking about a rebound on Monday. Jim just mentioned that too, that no one's calling for a rebound on Monday. I think Jim's putting money to work today as well. So now maybe I ruined it. Someone did mention maybe.
Right, so now it's over. Yeah. I think you have a better shot at rebounding next week. Right. So whether it's Monday, Tuesday, middle of the week, I think that's the key levels, or those are the key days that you think the market can really have a substantive bounce off the bottom. But as I said before, this is such a headline risk market.
On the sideline, I'd leg into this.
if you have cash on the sideline and you're a long-term investor, you should be buying stocks right now.
You can't pick the bottom, right?
Right, because you should weigh in, and you should be on a monthly. If you're a long-term investor, you're putting money in the market on a monthly basis, on a quarterly basis, or for your children, however you're staggered, you should be putting money on a regular basis so that it smooths out
so you
all
get
these
the dollar
volatile
cost
points, the
averaging
highs and the
these
lows.
things, right. All right, let's take a look at some potential safe haven stocks in a stay-at-home world. If people aren't going to work, if people are staying home, if they're cocooning, doing any of these things, the first stock that anybody asked about, Steve, is Netflix. What do you think?
Yeah, so Netflix is the obvious right there, because there's absolutely no exposure to the virus there, and you're going to be sitting home, you're going to be streaming. All of us stream videos and movies, but the problem is, if everything happens the way we're talking about, if we get a rebound in the overall market, then all of these safe havens, quote unquote, are going to sell right back off and retrace lower. So you could see a sell Netflix by Disney if this reverses.
The other thing that people have been saying, though, is that you got to look at some of these other stocks. You like Zoom. Why do you like Zoom?
Well, I do like Zoom because, first of all, I've been a germaphobe for years before it was in vogue to be a germaphobe. Really? Yeah, I don't like shaking hands. I don't like being in a crowded places.
Dirty beard with all yesterday's.
Who says it's dirty? I take 2 showers a day.
You do?
Maybe, of course. Why?
After the gym?
Oh, you have a problem with the hair. Women have a problem with hair. You can't shower. Yeah, every day, multiple times. But I take 2 showers a day. It's great. All right, but I digress.
I've done actually more, actually. I have.
On a bet?
No, sometimes I'll go home, take my makeup off, I'll do that. I go to the gym. I've had 3 or 4.
Now, when you're in the shower, where's the hair? See, a best defense is a good offense with Joe. You got to keep them off you.
And you played that well because you're only here for another 10 minutes.
Quick, say something, Becky. He's going to jump in. He's thinking.
A weave you can actually leave on. That's one of the.
All right.
And we lost Cy Sperling. That was but we digress. Yeah, let's stick to. We did. Did you see that?
No, I did.
A few weeks ago.
Yeah, made a point of it here.
You did, yeah.
So I guess the takeaway is watch out for these safe haven plays, because if the market reverses, then a lot of these safe havens are going to give back a lot of their the run up. And the other stock in there was Zoom, Peloton, Netflix. Peloton watched the 29 level. That was the IPO price, trading right around there.
Okay. Coming up, a lot more as we continue this morning. Oil stocks taking it on the chin recently, but our next guest has a reason for buying them now. We'll talk about that. And as we head to a break, take a look at the biggest decliners in the Dow over the last week. Stay tuned. You're watching Squawk Box. We're back in a moment.
Plan to retire, plan to live. An annuity helps cover your essential monthly expenses, so you're free to live the life you want. Find out how an annuity can give you lifetime income at protectedincome.org.
Exploring the heart of historic Europe with Viking, you'll get closer to iconic landmarks, to local life and legendary treasures, as you sail on board our patented, award-winning Viking longships. You'll enjoy many extras, including Wi-Fi, cultural enrichment from ship to shore, and engaging excursions. Viking, voted #1 river cruise line by Condé Nast readers. Learn more at vikingcruises.com.
I was missing teeth. It was painful to chew. And that's what originally drove me to ClearChoice.
When a patient comes in for their free consultation, oftentimes they're not happy with their dentures. Dental implant procedures, they're more permanent. The materials are made with a higher level of technology.
Implants are like normal teeth. I can now eat whatever I want. It's wonderful.
A hard 20 after a hard day isn't for everyone. Waking up before the sun isn't for everyone. But at $58 a month, Peloton is for anyone who wants it.
We see home staying cooler without the planet getting warmer. At Emerson, when issues become inspiration, creating a better world isn't just a result, it's a responsibility. Emerson. Consider it solved.
Do you have enough cash to buy something into weakness, or do you need to borrow money to make that happen? If you don't have a decent amount of cash on the sidelines, you shouldn't do any buying. If anything, maybe do some selling the next time you get a moment of strength. Watch or listen live on the CNBC app.
This is a crate from KiwiCo. Each crate has an awesome science, art, or engineering project inside. Parents can order online and it ships right to your door. Learning has never been so fun or so convenient. Get your first month free at trykiwico.com.
All of my patients should have a Dexcom because it's just more information. Why wouldn't you want that?
Being able to see your numbers in real time gives you the knowledge to see the future. It's awesome.
Dexcom showed me that I was doing a dip and then a spike in the middle of the night, which allowed me to adjust my basal rates. I'm not waking up in the middle of the night and my numbers aren't going crazy.
Now you are in control, and that is so powerful.
Hey, guy, ED issues? We got this. Today's your day. Go to forhims.com/ED.
Welcome back to Squawk Box. The energy sector has been beaten and bruised in just about every other adjective you can use. The oil price is tumbling further into bear market territory. WTI is sitting right now at 32% below its 52-week intraday high hit last April. But a number of energy stocks have a very high dividend yields, and want to take a look at a couple of them and talk about how to play the energy market given the dip with Rob Thummel. He is Senior Portfolio Manager at Tortoise Capital Advisors. Good morning to you. You actually think you should buy right about now?
Yeah, you know, the energy sector, Andrew, has been beat up. You're right, and you know, there are companies out there though that have resilient cash flows. Energy is essential. We all need energy. We're going to continue to use energy. Energy demand globally has increased 36 out of the last 37 years. And throughout that period, we've had other instances of virus outbreaks. You know, right. There's been SARS, there's been MERS. And so we just think that energy is so essential, and obviously it's very cheap from a valuation perspective right now.
So we're looking at a screen right now. You're looking at Chevron, you're looking at BP, you're looking at ExxonMobil. Are those the stocks you'd buy?
Yeah, so those are the biggest energy companies in the world. We like more of the midstream energy infrastructure more than the producers, because in energy midstream, those are where the resilient cash flows are because they don't have commodity price exposure. BP, Chevron, Exxon all have commodity price exposure. And in the energy sector today, really the most precious commodity is cash, and companies that are generating cash to buy back shares and pay dividends. And in some cases, in the case of Exxon, they can't do that. Chevron and BP can.
Since this is all going to follow whatever happens in the sort of global economy, given the coronavirus, what's the firewall for you? What's the bottom?
Yeah, well, you know what? I would hope, like the entire market, we're getting really close. I mean, you know, energy is at a multi-decade low, frankly, if you look at the sector index. Right. And so we're really close to that, I would hope to say. And like I said, I think we see cash flow growth in the future going up significantly.
Rob, thank you so very much for joining us this morning as we try to better understand this market sell-off. Steve Grasso has been with us. Thank you for sitting and hanging out with us.
Thanks for having me. Good luck today.
Good luck to you.
You were a value added. I think you were a calming influence. And I'm not saying we should be calm, but there are times where you just don't want to be running around with your... Here we go.
Yeah,
with your hair on fire. I didn't like the hair comment.
I'm not at panic. I'm not at panic mode. And usually,
I'm glad you were here.
Usually in the Wall Street business, when other people are getting nervous, you have to stay steady. Mm-hmm. I think that's what makes a better trader, makes a better investor.
I agree.
And I'm just not. I'm not prone to panic, and I'm not panicking over.
I think that it was good to have you here. Coming up, our guest host, and this is exciting for the rest of the show, making waves with his op-ed in the Journal this week, calling for the Fed to lower rates immediately. Former Fed Governor Kevin Warsh is with us. He's famous for a lot of things. Anyway, you won't want to miss what he has to say. Stay tuned. Squawk Box on CNBC is coming right back.
Luxury. In India, I discovered that true luxury isn't something you buy off a shelf. True luxury is a feeling that you are the Maharani of your world, and it can be all designed around you. All the beauty is yours. All the music is yours. India showed me that luxury doesn't follow designers and brands. True luxury follows its own heart.
Incredible India.
When I lost my sight, my biggest fear was losing my independence. So I've spent my life developing technology to help the visually impaired.
We are so good.
We built a guide that uses IBM Watson.
The library is in 40 meters.
To help the blind. It is already working in cities like Tokyo.
Your gate is in 50 meters on the right.
My dream is to help millions more people like me.
Look who's cheap now. You are. And millions more just like you with cheapoair.com. Because when you spend less booking your flight, you're free to do more, see more, live more, and save more. So you can start planning your next adventure. Just download, click, or call and save on the best flights.
cheapoair.com.
Go ahead, be cheap.
What if you invested $5 a day, every day, and you invested the spare change from everything you buy? And what if your market returns were reinvested automatically? And imagine if you did this for a while so your money could grow. And what if all of this was easy?
Seeking safety from the sell-off. Finance expert Jeremy Siegel. Where investors are turning now as global markets hit correction territory. Squawk on the Street, 10 a.m. Eastern today. Watch and listen live on the CNBC app.
A history-making week on Wall Street, and it's not over yet. Stocks are getting rocked. The February sell-off intensifying as the coronavirus spreads. The Dow falling 1,200 points yesterday, the biggest one-day point drop ever. That brings the total point loss now for the week to 3,200. The S&P 500 is down more than 10% for the week. That's the fastest ever correction from an all-time high. We're going to help you to navigate all of this, the steep and sudden market sell-off with insight you can only find right here on CNBC. In this hour, we've got the perfect guest host amid all of the turmoil. A man many think could replace Fed Chairman Jay Powell. Kevin Warsh is here. It is Friday, February 28th, and the second hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box here on CNBC. I'm Joe Kernan along with Becky Quick and Andrew Ross Sorkin. U.S. equity futures at this hour. Would you call them stabilizing? They were down 600 at one point today. They're down about 468.
Down 468 is net stabilizing?
They were down 600. It's not 1,000.
It's half 1,000.
And it's not
about half of 1,000
on a Friday afternoon yet either, which is what worries me.
I know, but maybe if everyone's thinking that, maybe it doesn't have it. As we know, it depends on the 10-year. We should take a look at the 10-year, which I saw as low as 1.17. We just saw it back above 1.2. Every little basis point back below 1.2. There it is. But every basis point that I see, I feel a little bit better as it. And you wouldn't usually want yields to go up, but we want yields to go up if you want some stabilization in the stock market, I think.
Our guest host this morning is Kevin Warsh. He is former Fed governor and distinguished visiting fellow at the Hoover Institution. He's also author of a Wall Street Journal op-ed that was published yesterday that got a lot of attention. It was headlined, "The Fed Can't Wait to Respond to the Coronavirus. U.S. central bankers should lead a global response." Kevin, it is great to have you here today.
Becky, thanks very much for having me.
We spent a lot of time on our air yesterday talking about your op-ed. The markets, I think, took it as a signal as to what might be coming. In fact, very early yesterday morning, you did see the Fed futures indicate that we could see a cut as recently as March. Let's talk about why you wrote this right now, what you're seeing.
So I wrote it because, I'm not in the middle of these things. Chairman Powell and his guys are. it's a tough moment to be at the Federal Reserve. In the middle of a week like this, all you want to do is get to the weekend. Get to the weekend where you can have no markets trading, or you can sit down with your kitchen cabinet, ask hard questions, and think what to do. And so I thought it was good advice. It was the sort of advice that we got in the darkest days of the crisis. I remember Marty Feldstein, who's no longer with us, but a great friend and mentor, who, when we were trying to figure out what to do, we were at Jackson Hole, and he went up and said, the Fed needs to cut rates materially, they need to do it now. And we said, oh, well, that's not so helpful. But he made us think again about where we are and reassess things. So it was just to give my best candid advice. They know more than we do about the state of the coronavirus. They know what their tools are. They've certainly had discussions, I would think, with their counterparts around the world. That's my unvarnished view. Get them to the weekend. Let them take stock. The gloss of history forgets all the mistakes we made early in our crisis. I think they'll get to the weekend and they'll think anew about what the path is and what markets are telling them.
Why do you think a coordinated global rate cut would be useful at this point?
So I think it's likely to be a gunfight out there. When I look at the world's big central banks, not a lot of them have guns. Maybe the Fed has a bigger gun than everyone else, but the Fed probably has a knife. I wish they had a big, powerful gun coming into this moment. I wish they had more ammunition. I wish, for the discussions we've had on this show over the last 9 years, they had prepared themselves for an exogenous shock, because we certainly didn't know this virus was coming, but we knew that complacency in a world like this sets itself up for big tail risks. But you go to a market with the Fed you've got, not the Fed you want. They've got a knife. There's a gunfight. You might as well go find some friends that also have knives and see if you can't do it together.
So you're saying
there's some knives out there in the other big central banks.
You think there's some they're knives, not guns, because rates are already so low and negative interest rates in many parts of the globe?
Yeah, I mean, this is a time where the country needs to come together, where has-been central bankers and the current generation of central bankers need to unite. But my judgment early in this crisis, as you know, was that the Fed needed to restock its toolkit, restock its credibility, create it such that they could shrink its balance sheet and prepare for whatever big shocks happen. And, you know, what we find is that opportunity was missed over the last 9 years. But the Fed will be successful here. I'm not doubting them. And believe me, we made plenty of mistakes early in our crisis. So if this thing manifests itself in an ugly way, my instinct would be that Chairman Powell needs to reach out to his counterparts around the world and buy some time. That's what a quarter point could do.
Let's just say, you just said if this manifests itself in an ugly way, meaning we're not there right now, meaning it's not necessarily next week that the Fed needs to cut?
I think the sooner they cut, the better. If I were giving them advice, I would say get to this weekend, take stock, reach out starting at the close of business today to the world's central bankers, and at the very least on Sunday night before markets open, have a unified statement from the big central bankers in the world that they are all over this. They're closely monitoring the situation. They're prepared to take whatever action is appropriate in their jurisdictions just to see whether they can't buy some time and learn more. The purpose of that isn't just a signal to the markets. It's a signal to businesses out there that they shouldn't decide to give up on 2020, give up on their growth projections, pull back on their CapEx, that a little time can be bought. That's what central bankers can do. We can buy a little bit of time, and I'd suggest that they better do it sooner than later.
Do you think that creates a firewall in terms of the market? We've been talking about what is that fire? What is that inflection point piece of news that would have to come likely from a government entity, or potentially, obviously, if a vaccine emerged, that would change the direction of this market right now?
Given their tools, I wouldn't call it a firewall, but it could be a period of détente, a period at which the world can learn more about the disease, learn more about the economic impacts, and make it such that negative financial markets don't become a self-fulfilling prophecy and find their way into the real economy, such that when people get their heads above water, the economy is in a much worse
Steve
place.
has been asking that question all week, Leisman. What's a quarter point got to do with curing coronavirus? And just making the point that it's not going to be just a panacea. It's not going to inoculate us, but I think that's the answer that Steve's been looking for. Détente that buys us time and get
an admission that it's not in the real economy right now, that this is a market.
Well, I'm not so sure about that. We aren't seeing it in data from the Bureau of Labor Statistics, data from the Department of Commerce, but of course we wouldn't. When you talk to business executives, they are taking stock of this and making important decisions about earnings and investment over the next couple of quarters. So it is in the real economy, certainly in places like Asia and Southeast Asia, certainly in Europe. And I'd say it's finding its way into the real economy here.
Here's the question. If you're a CEO today and you had a big CapEx plan that was supposed to, you're planning on building a factory or whatever it is that's on your agenda, and right now there's probably a handful of meetings saying maybe we should hold off, maybe we got to wait, maybe we should push this off a month. Do you think that a decision by the Fed to lower interest rates is going to say to them, actually, let's not hold off? I think they're still going to say, we got to hold off until we understand what's going on here. They're still going to say non-essential international travel, non-essential domestic travel. Folks, we're not doing that right now. Don't you think?
I do think that they're in a period where they're holding back a decision. But we might find ourselves in 6 weeks where we'd say we now understand the science of the contagion. We understand the effects in the U.S. I think for purposes of an administration and a central bank that cares about their domestic economy, they don't want that CEO to put that CapEx project on the shelf until 2022 right now. They want him to wait another 4 to 6 months to make that decision. And I think it's awfully important because the global economy is at a very important moment.
There are times where if you lose a certain amount of GDP for one quarter, you might get it back the next quarter, and there's times where it's gone for good, I think. Do you have a feeling of whether we could get a snapback where we regain some of the lost ground, or do you think some of it's just gone?
In economic models that are used in prominent central bank institutions and academia, it's gone one quarter and appears magically the next. That's not my sense of how the real economy works. The path to bring that project back online, to getting the animal's spirits back, takes a bit of time. So I wouldn't say we have a Q1 problem that will be miraculously solved in Q2. I think it takes a bit longer than that for global supply chains to adjust and for the world to get comfortable in a new environment.
But there could be a really bad outcome with no therapeutics and no vaccine, or there could be something much less long-lasting if, as you say, the science, we can develop something quickly or get a better idea of what the eventual pandemic is going to look like. It makes a difference. What happens from here on out, it's part of the uncertainty.
That's right. I mean, at a certain level, the pain at this moment is inevitable. The suffering is optional. What I'm trying to suggest is the Fed should buy a little time, see whether they can make some of the suffering go away. No panacea. And I think an international response as soon as this weekend would be good. I don't know what the tenor of things are inside the Federal Reserve, but I would guess
suffering must have an idea.
I don't really have much of an idea. I'm calling this one from the bleachers. They might know things we don't know. They have a regularly scheduled meeting on March 18th, but if I were them, this would not be the time to say, well, I'm going to preserve my ammo. Going back to last fall, they used a bunch of ammo when the markets were melting up. In retrospect, and for those of us that were following us, that didn't seem like the best time to use it. Again, it speaks to what you think the job of the central bank is. My view is the job of the central bank is to deal with big, ugly, unanticipated tail risks, at which point you should be really aggressive. But when you're in normal peace times, my view is not central banks should be preoccupied with moving inflation